It's very odd to be back here, actually, because prior to COVID, we used to come here quite often. So we haven't actually been here for about 5 years. I haven't been in this auditorium for ages, but we had some really great events here. There was one particularly good one where we had Antonio Horta Osorio talking about his multi-brand strategy for Lloyd's at a time when everyone else was saying you really needed to go the HSBC route and be monolithic. So it was very interesting. I have to say, we're going to take full advantage of the audio visual. So I've got a couple of videos in my presentation today. There you go. It's all going to be very exciting. As you can see, the theme of our annual forum is starting and scaling up brand and technology, securing investment in an uncertain economic climate. That's a slightly wordy way round saying that we have been fascinated by the difficulty that brands have in raising the money to get going. Even brilliant ideas quite often fall. It's a bit like a grand national, you know, like if you were an entrepreneur, which I have taken to referring to as brandpreneurs, which everyone sort of groans at. But basically, you know, if you work for a big company like Unilever, very often you've got a secret aspiration to leave and go and set up a goo or something and make your own brand and make it successful. But I think very few people who are in that position have the remotest idea of the marathon or the Grand National they're going to have to go through to even get the startup capital and then go and get the further stages of capital to the point where they may be able to exit. And so given that our name is Brand Finance, I thought, oh yeah, well, maybe we are in a position to actually enlighten that slightly. So we did an event like this in the autumn, and it was pretty well received, and so we're doing another one. And I think going forward, we may well do similar events again, because I do think that there are various organisations like Marketing Society and so on who do great events about finance for non-financial managers, but they don't necessarily home in on, well, where is the money coming from? How are you actually going to get your seed capital and that kind of thing? So really, this is meant to be an exploration of that. And the first half of the morning, as you can see, we have three representatives of interesting brands who are going to talk about their steeplechase, you know, what it was like, how difficult it is, what recommendations they've got, and so on. And then after the break, we're going to talk about whether the conditions are changing in the world of finance and financial reporting that might make it easier for the next generation. Now, the point that I keep making is they keep going on and on about the fact that UK growth is very flat. It is very flat. So where is growth going to come from? Well, you know, it could come from the big, giant organisations, and there are some that grow very fast, but you don't pull a whole economy along by a few brilliant individual performances. And, you know, we're going to show one later on, which is pretty good. You make it by having the Mittelstand, or whatever they call it in Germany, doing well as a whole. And I think it's fair to say that in Britain, we don't do very well in the Mittelstand. And that is because there is an absence of the availability of finance. And if people like Jeremy Hunt and Rishi really want to supercharge the economy, certainly in my opinion, they need to be focusing in on the thing which we are going to talk about today. Anyway, I'll just get on with the presentation itself. First of all, I'm showing this chart, which is a 20-year study that we've done where we look at all stock markets worldwide and we demonstrate the amount of money in their balance sheets that is intangible assets, so recorded in their financial returns. The blue and the green are bits that appear in their financial returns as a result of acquisitions, and the light blue bit is the bit that we call undisclosed intangible value. So in other words, the excess of value that nobody really quite knows what it is. It goes up and down quite a bit, but it's large. So overall, the amount of intangibles is about 50% of all companies worldwide. You may have seen a chart that is produced in America by Ocean Tomo, which shows it's like 80%, but that's because they are looking at NASDAQ and the New York Stock Exchange only. And that those two exchanges are particularly highly intangible. So, but the rest of the world also is very intangible. Now, to me, this is a pool that can be used to generate the growth that I'm talking about. I'm not going to say more about this because Annie is going to do a presentation on it later. Other than to say, within that group, there are a variety of intangibles. The question is, can they be valued reliably enough, those green stuff there, can they be reliably valued enough in order that very skeptical bankers will actually lend money, or investors will lend money, against companies that have virtually none of the blue stuff. This is the main problem with modern economies. Most companies have almost nothing of the blue stuff. In fact, they might even be negative on the blue stuff being the tangible assets, the working capital. They are very, very thin companies, but they quite often have very interesting, valuable intangibles, but nobody gives them any credit for it, so they find it very hard to expand. Even brand finance, frankly, I have occasionally asked, could we borrow against the intangibles brand finance has created? And we are very conservative, but we've got a reasonably healthy company. And the answer has always been no. If you don't give us a personal guarantee, we're not going to lend you any money. So it holds us back, even though we're quite successful. Anyway, the thing that I wanted to say was that what lies at the bottom of all of this is the fact that for many, many decades, accountants in particular have had a very skeptical view about the reliability of all that stuff. They don't really believe, I mean, some people say that accountants don't believe in intangibles at all. I don't think that's true. They do. They're not stupid. The thing that they don't believe in is whether or not they can be really reliably valued and whether those values will hold up in the event of a crisis or a shock. They kind of go, whoa, what happens if you go bust? I'll never get my money back. And there are some very interesting new developments in that, which we're going to talk about in the second half of the morning. But, you know, back in the 80s and 90s, there was just a general concern about valuation. To be honest, made worse by the introduction of brand valuation. Terry Smith, one of his earliest, does everybody know who Terry Smith is? He's the guy who runs Fundsmith. He's one of the biggest motor mouths in the industry about a good and bad accounting practice and reporting. He used to work as an analyst at Citibank, and he produced a book called Creative Accounting, I think it was called, and he produced this thing called the blob test, where there were 12 things, and he said, if a company does any one of these, give it a blob. And one of the blobs was brand valuation. Obviously, the more blobs you had, the worse a company you were. And I seem to remember that the company that came bottom of his table or top of his table of blobs was actually Grand Met before it became Diageo. They did every kind of what he said was dodgy creative accounting practice. They got 12 blobs. What he didn't realize or didn't think about was that they were one of the clients of Citibank. So he was immediately fired and set up his own company, which is called Fundsmith. He is the guy that was having a go at Unilever for all that stuff last year about sustainability, saying this is ridiculous. Why are you doing all that sustainable stuff? It doesn't make money. Don't do it. Don't do it if it doesn't make money. Anyway, so as you can gather, back in the 80s and 90s, there was huge skepticism about valuations generally. They were all just blobs. And gradually, bit by bit by bit, the accounting standards have improved so that you are now required, when you make an acquisition, to value them. The globally recognized accounting and reporting standards have gradually improved and are still improving. There are various parties working away on it, though it takes glacial speed. And there are now globally recognized standards, both from IVSC and ISO, but I'm not sure that most finance directors still even believe in them, even though there are standards. So there is a bit of a challenge to get over it. We've got improved financial reporting, valuation, and also certification of valuers. There is now a sort of recognition of brand values and other IP value. There is greater transparency, no doubt at all. And possibly there is an opportunity for brands and other intangibles to be used as collateral. Okay, that's kind of like wishful thinking, which is why I put question marks against it all. It is still up in the air, but I think we are at a moment of change. Anyway, that's my intro to why we're doing today. And one of the things that we have used this as an opportunity for, as it's St. George's Day today, is to launch the Brand Finance 250 top brands in the UK. We've been doing it since 2017. It's got 34 sectors in. It's powered by a thing called the Global Brand Equity Monitor Research, where we do a very large-scale research amongst general publics about the quality of these brands, whether people are aware of them, what they stand for, etc. So they are not just financial valuations. They are driven by real research. The total business value of the brands in the study is 2.6 trillion, and the brand value is about 406 billion. So we're saying there's a lot of brands floating around, and that's just the top 250. Here are the ones that are at the very top. Perhaps not surprisingly, it's oil companies and giant commercial services companies, retailers, banks, and so on. So maybe it's not that much of a surprise, though there has been very interesting coverage and activity around, for example, well, around all of them over the last year. But look at what's been going on with EY. that is a very interesting brand-led story. What's the word? They're at 6s and 7s about what they do, about their branding and their corporate structure. But the 10 strongest brands, EY, actually, according to us, or rather according to our research, is the strongest brand in the UK, which is weird considering what's happened in the last year or so. And the other professional service firms do pretty well. But creeping in there are interesting brands like Fairy and Costa and KitKat. What this is the proportion of the values that comes from the different sectors. In a way, it's kind of like a mark of shame in a way, because, it's all commercial services, oil and gas and banking. You would expect to see a number of other sectors doing better than they are. I would anyway. And so you look at the actual distribution of the values. There are millions and millions and millions of tiny little brands. And they've slightly shrunk in the last year because of the economic circumstances. This is the slide that shows that star performer I was talking about, Arm, where there's only one brand in the semiconductor sector in the UK, and it grew 400% last year. As you can see, there are a number of brands in the other ones, but they're all tiny by comparison. And we pulled out this slide. The UK still lags others in tech and AI-driven opportunities, but we say it's got the opportunity to grow. I don't know whether it has, but I'm sure that Abhinav, who is the global CMO of TCS and who's going to join me in a minute, and who very kindly has sponsored today's event. I hope that, Abhinav, you're going to be able to answer that question. Is it true that Britain could grow from its piddling 1% to something decent? So briefly just looking at how Arm has done, this shows the opportunity if you can get things right. Huge growth, and this is the brand value, but obviously their corporate value is much higher. Their brand strength has grown dramatically. They are excellent at what they do. I did actually ask our team to find funny ads. They dismally failed on Arm. Obviously, the AI sector is a joke-free zone. And I've watched that about 5 times. I still don't understand a word of it. Who are all those companies? What do they do? I really don't understand any of that. What is ML? I'm sure you'll answer that in a minute. Anyway, but so from the sublime to the ridiculous, it is possible to create great brands even amongst, bread shops. So look at what Greggs has done. They've actually, they haven't grown so much this year, but over the last 5 years, they've been growing very, very fast. They are one of the strongest brands. It's slightly edged back down again, but they're still doing exceptionally well compared with all the other brands. And here's an ad from them. I think that counts as a very subtle joke. And if anyone's had a vegan sausage roll, has anyone had one? Does anyone like them? No, they're absolutely hideous things. They don't taste of anything. But apparently they sell a lot because no one else is selling vegan sausage rolls. Anyway, I'm sure they're a wonderful brand. I was saying to someone yesterday, it's amazing. You know, Greggs used to be that grungy thing down the high street, and now they've got an amazing shop in the Westminster Tube Station, right by where Parliament is. So they've really come up in the world. Anyway, generally speaking, it's fair to say that UK consumer brands are not doing that brilliantly. They have, you know, in cosmetics, food, and spirits, they've all gone backwards in the last year. Part of that thing about, I would say it's two things. Part of the thing is the economic situation. And part of it is that the retailers are basically clobbering them because they're making own label and going, right, we're going to have that money, we're not going to let the brands have it. So if they don't innovate, they've got a problem. So the environment in doing all this brand building is more difficult than it's been in a lot of categories. So anyway, I'll just put this up here for those of you who aren't familiar with the many hurdles you've got to get over in that Grand National I mentioned. You know, when you start, you probably finance a thing yourself, you borrow money off your mum. You know, in your second stage, you get some bloke who gives you seed money because he just got a bit of money he made somewhere and he thought, well, I'll give that a punt. You get a bit of bank financing, though not much, frankly. Early state venture capital funding, maybe we'll hear a bit about that later on, and certain tax breaks and stuff like that. The big point is when you get into the second stage with Series A, B, C, D, E, that's where you are dealing with the real pros and you've got a real problem, which we'll hear about later on. And then finally, the big one is the public market. And again, we're going to hear from someone from the London Stock Exchange, which should be very interesting. So that is the outline of what we're going to do. I'll just finish by saying LSEG has done a great job of updating and improving their brand over the last year or so. And as you can see, their brand value has gone up. We're going to hear from them later on in relation to one small part of their business, because we have to bear in mind that the London Stock Exchange is now actually a small and aspirational business which is struggling a bit and needs to reinvigorate itself in order to become world class. So we'll hear about that later. I'm now going to have Abhinav on the stage, and I'm going to ask him a few questions about AI, which, as you gather, I don't know anything about.
Let me start by answering the question you asked while you were talking, right, about the growth in the UK economy and its future, right?
Yeah.
I think as we look at the discourse here in the UK, I think that pendulum keeps swinging from one end to another, right? Often, if you look at the political discourse, they are, and I can use no other term for it, often they're delusions of grandeur, right? And then if you look at the societal dialogue, it's this extreme pessimism, right? There's no future, whatever. I won't use the B word, other things. But if you look at how the rest of the world looks at the UK, it's neither of these. It's, I think, squarely in the middle, and it has strong fundamental value. I mean, I look at, from our group's point of view, and at the TCS point of view, if you look at our growth over the last year, our standout growth unit has been our UK operations. Really? I think people are surprised to hear it. But if you leave out some of the much smaller emerging markets, the UK is our second largest entity. And last year it grew faster than anywhere else. We see a lot of business on the technology side, and we continue to invest, not just in technology, but for the group, we see a lot of innovative potential in the economy here. The Tata Group has invested in a new company called Agratas, which is building, the electro-mobility economy by creating batteries. Jaguar Land Rover is leading the world in terms of the shift towards electric vehicles. And at TCS itself, we just inaugurated about a month ago one of our innovation centers in the UK. It's called a Paceport. It's there in our office. You came and saw it, David.
Yeah,
I think you came and saw
right.
it about a month ago. And since its inauguration a month ago, I've not been able to find a room in that Paceport because all of our customers and partners are really excited about the future and what they can do with AI and other technologies. It's just full every day with people brimming with ideas. So, I mean, I would tend to be a lot more optimistic about the potential for growth here than maybe the average person on the street.
Right. Well, I was meant to ask a question about TCS, actually, and start with a congratulation for what a brilliant job you've done.
Thank you.
I mean, basically, we've known you for about 15 years, and in that period, you've gone from being just one of the IT services companies to being a real challenger at the very top of that particular list of players. And you're always doing interesting things. I mean, your sponsorship of marathons is fantastic, and it really fits the thing. But we're meant to be talking about AI, and I was going to talk about the Paceport. One of the questions is, I certainly don't understand the technicalities about AI, but I do wonder what can it do. And in the context of the thing we're talking about here, you kind of wonder, well, if you're an entrepreneur or brandpreneur and you want assistance or support to either find finance or to run your company better, and we frequently hear about people who set up companies and they fall at the first fence because they don't know what they're doing. Can AI actually make a practical difference to those people? I mean, how does it, what is it really contributing other than being a great acronym?
Sure. I mean, I think if you look at the last year and a half, AI is the thing which has dominated global conversations, right? You and I were in Davos a few months ago. I was just joking, you can't walk for 10 meters without bumping into something, an event on AI or a billboard or somebody launching a report on it, right? And I think it's been because of that moment where we've been working on AI for a long time. It's since the 1950s we've been working on it. Even with our customers, if you look at it the last 10, 15 years, we've been doing a lot of work on AI in the enterprise level. It's not exciting work, so it's not spoken about a lot because it's more about deriving insights from data and pattern recognition and predictive analysis, all of those things. But I think with the consumerization of AI, where the power is available to the common person, we've hit that moment where, maybe similar to when the internet and saw email and chatbots and things launch, which made everyone see the potential of it. And we saw what happened after that, right? So I think AI has a lot of potential. It is both a disruptive technology, but a technology on which you can really build industries on. There's a mix of things. I mean, there's a lot of hype on it, right? What we're doing with our customers is we're trying to see the practical uses of it. And how can you use AI to not necessarily completely reinvent your business? That may come in the future. But how can you add value to what you do right now, right? So if you're an insurance business and you're processing claims, how can you use AI to be faster and deliver a better consumer experience and things like that? The economic potential is huge. I think a lot of companies have estimated it. I think one of the estimates which you see is that in the next 10 years, if the opportunity is to be realized, we can add an economic increment equivalent to both the Chinese and Indian economy, to the global economy, if we realize the potential of AI. It also has challenges on the other side, right? I think we have to use AI very carefully, keeping in mind safety and ethics, and in the wrong hands, or used in the wrong way, there are many risks also which are associated with it.
I think for me, one of the problems with AI, it's sort of like Y2K, or various things like that along the way with technology. They're held up as sort of ghastly bogeymen that are going to get everyone. Like everyone's going to be out of a job. There isn't really much evidence at the moment that AI-generated things have really made a big difference. I mean, do you think they're going to start rolling? Have you got examples that are going to start rolling along where everyone goes, I see. For example, talking to the International Advertising Association the other day, they're all terribly scared that the whole ad business is going to disappear because you're going to get AI chatbots or whatever you call writing all the ads in future, and there won't be any ad industry. I mean, it sounds ridiculous to me, but I mean, what's going to happen?
Yeah, you know what? Even we've been having this discourse over history, right? I'll take you back, 100, 120 years. With the invention of the car, the entire horse rearing and horse riding industry panicked and said, hey, we're not going to be rearing horses, nobody's going to be training them. What will happen to the saddle makers, carriageways? And sure, definitely that industry declined, but look at what the automotive did to the world, right? You created an entire industry in automotive, AEM suppliers, roads and infrastructure. It made supply chain easier, which brought modern retail to where it is. And I think that's the thing. Every time there is a disruption or a new technology, there are fears associated with it. There will be some impacts. There will be structural changes economically. In terms of jobs, I think there's a lot of discourse on that. I think the World Economic Forum says that if you look at even the next 5 years, while there'll be some jobs will be impacted by AI, a lot more new jobs will be created by it as well. So they're expecting a net increment of 12 million jobs due to the possibilities on it. It does require education. It does require training. Training is so important, even for us, right? I mean, we are a technology company. We are at the cutting edge of the cusp, but we needed to retrain our entire workforce on generative AI and AI tech. So in the last 14 months, we've trained about 50% of our workforce on Gen AI tools, and we're continuing to do so.
One of the things I read the other day in The Economist, I think it was, they were talking about the fact that one of the biggest industries that's going to suffer from AI is actually commercial services. So people like Deloitte and Ernst & Young, who provide a lot of advice, If you've got AI, you don't need them doing it. You just do it with AI. Is that true?
Well, our view is it becomes a tool, right, for any industry or any kind of profession. If you embrace technology, you figure out how you can add value through it, it becomes a tool for you. Look, let's look at the marketing world, right? I think there are a lot of people here. I think most marketing teams are embracing AI. There's some fear related to it as well. But today, I think the stat is something like 65% of companies are already using generative AI inside their marketing processes. The place where it's most used is in terms of content and copy. Whether you use tools like Chat GPT originally, or copy, or writer is taking a lot of interest currently, and it keeps evolving. A considerable amount of the copy which is being generated through AI. Where it goes wrong, and you read about it in the newspapers, is when companies just completely automate it and let things go out. I think where it works really well is when you use it as a productivity tool, but you have humans in the loop who look at the quality of the content before you publish it, right? But it's been great. I mean, I've been talking to many of my peers. They're like, what it does for us, they say, is, like, you're talking about ads, right? The ad industry. So, of course, if you're going to create a Super Bowl ad in which you're going to invest tens of millions of dollars, chances are you're not going to use any of the Gen AI tools to do it. You're going to use the standard mode of the advertising industry. You're going to build it. It has to be creative. It has to engage. It has to make that impact in 30 seconds. But if you look at your Twitter, sorry, I keep calling it Twitter, X, or if you look at your X feed, or a standard video which you're putting out on LinkedIn, the day-to-day drudge, a lot of it can have a lot of productivity on it, which frees up the time for your team to focus on strategic things.
Right. Well,
Yeah.
we got a few minutes left, 2 minutes left to be precise.
Sure.
What's the story on sustainability? There is growing skepticism that it is a differentiator, that it's gone too far and it's coming back the other way. How does TCS view that?
Yeah, I think sustainability is something where I think the political discourse, we all read about it, it keeps flipping and flopping. But I think from the business community side, most businesses have made a significant stand on that they want to be part of the solution. We are no different at the Tata Group. The Tata Group has this initiative called Tata Alingana. It's a Sanskrit word which means to embrace the planet, and which means that across all our group companies, there are 119 of them, we intend to be completely net zero by 2045. TCS, being in a technology business, it's a little easier for us than the steel making or aviation business. We intend to be net zero by 2030. The good news is we are 2 years ahead of schedule. But to be honest, our focus, we'll do what we need to as a business, but our focus is how can we use the power of technology to do good to our larger ecosystem, our clients, our partners. So our sustainability units have developed over 200 technology solutions, which are helping our clients optimize, how do they use energy, how do they capture the data around their supply chains, and how do they make their own businesses with a lesser carbon footprint. And we're also taking it to our partners. I mean, you were talking about marathons. We had the TCS London Marathon take place on Sunday, just a day ago. And one of the things we're working, it's a fantastic, iconic event, great day, a lot of runners. There was a children's run on Saturday in which 10,000 kids across the UK came in and ran. But one of the other facets we're working with the TCS London Marathon on is sustainability.
Right.
Is how do you, because marathons tend to leave a big footprint on that day. And I want to commend the London Marathon events team on what they managed to do. Is they're doing some really, really interesting things. They're using renewable energy around their things. All the shirts which you see the runners wear, they're made from recycled polyester. The medals that people proudly wear after running 42 kilometers. I don't know if any of you are marathon runners. I just can't even imagine how people do that. But that medal is made from recycled zinc. So many things. We're encouraging people to bring their own water bottles. Or if there is hydration provided around the course, it's from recycled plastic. The mile markers are made from ocean-recovered plastic. So every aspect of it is being looked at. And again, we're using technology there because we built this app along with the Council for Responsible Sports in the US. And we made it available free to events like London Marathon, but any sporting event in the world, which allows them to capture their footprint and then do something about it. So London Marathon last year achieved the gold standard. There's one more standard above that, the evergreen one, and I think they're working towards getting there in the next couple of years.
But all the solutions you're doing on sustainability are playing to the profit motive now. in that they either save money on cost or add money in terms of demand. Is that right? Or are people still, just doing it for the sake?
I mean, it's a mix of both. I mean, in many places it can be profitable to protect the planet, and it's a good, it makes good business sense. And many places businesses need to take the hard decision that everything is not profit. You have a responsibility to this community and society and the planet. And even as a business, if you don't want it, your boards may want it. Your employees certainly do. Your investors do. And I think on the whole, and listen, this came out of all the COPs. On the whole, businesses are sort of leading this wave. Politically, it varies, right? And I think, and there's political change. This year, there are 70 elections over the world. Policies tend to flip-flop on who comes on power. Take an example of Australia. It was in a different place on climate. Then the government changed. Today, they're really making a big play in being a more sustainable country. So,
well, I think we better move on.
Yes, please.
That was fantastic.
Okay,
Thanks
you.
a lot.
Always enjoy
your support
with you, David.
And we're now going to hear from the first three speakers. So Will King is going to talk about King of Shaves. Martin Glenn is then going to talk about Chapel Down. And then Brendan Stevens is going to talk about Big Black Box. Three quite different brands and journeys. And I'll hand to Will. I think the format will be like 15 or 20 minutes and then questions from the audience. So over to you, Will.
Hi, everybody. So this is going to be a mixture of AI compressed and obviously my words and stuff in the slides, but I'll try and get you through it as quick as I can. And it all started off with this guy back in 1993, where I hand-filled 10,000 of those. So, David, we've known each other a long time, yeah? A long time. King of Shaves was founded in 1993. I was made redundant from my job, lost everything, got ump about that, decided to make something, product, I'm an engineer, and be my own boss. So if I effed it up, it would be my fault. And I'm hanging around here still 31 years later without a boss. So I've never had a boss. And that's incredible, really, because that never had anybody telling me what to do. So that's why my brother does tell me what to do at COV, because he's a bit more conventional, shall we say. But we gathered here in this trading hub of economic ebb and flow, and sometimes I'm reminded, as an industry, as mundane as shaving, it could also be a beacon of growth and innovation. It is, after all, a growth business, and I shave lives. And I often get a big laugh for a small laugh, but we're happy with the small laugh, because you probably hardly hear me here. But look, 92, I lost everything. If you remember 30 years ago, we had mortgage rates, interest rates, 12%. I had a flat on 12% that I just bought on a 95% mortgage. That wasn't very good when I lost my job. Mr. Lamont crashed out the ERM, future proxy for Brexit, new Labour elected to be concocted. The internet has not yet happened. But that was going to change everything. Is it working okay, the mic? Are you sure? Are you sure? So timing. Happiness in life is timing, ladies and gentlemen. Surfers wait their entire lives to get a perfect wave, and some never get it. Doug's been to Wembley twice with Cov now, lost on penalties. Could be in the Prem now, and could be in the FA Cup final. So clearly, obviously, the timing not quite right, but that doesn't matter. You've got to position yourself in life if you want to be where the opportunities are. I just happen to be well positioned, okay? I made redundant. So redundance was the best thing that could happen to me. I hated shaving, I got razor burn. I basically had studied engineering, new oil lubricated, body shop was huge, concocted a little mixture of shaving oil. It worked, made us think a bit gloopy, but invented a new market vertical. Everybody dissed it until Mr. Alfred personally listed it in Harrods. I then got it into Boots. Looking like that, that was the packaging, $2.99. Obviously, Gillette were absolutely quaking in their boots with that on the bottom shelf. But it changed everything. So we were the only men's brand to launch in the whole of the 1990s. The only brand. There are bazillions now of little brands out there all trying to be whatever, the next beard oil, the next this, the next that, whatever. But well, that was just fortunate, yeah? So life is also luck. And you've got, I'm quite an optimistic guy. So 2012, well, it was lovely in 2012, wasn't it? I mean, Boris, he was just the mayor, dangling on a zip wire, not buggering around with the country. We were flag waving. We hadn't had any Brexit stuff, or any pandemic-y stuff, and we hadn't had hyper-rapid advances in generative AI, which is going to sort of get smarter than us, according to us, the next couple of years. You know, we don't know, do we? It might, or it might not. And you've got a lot of tragedy in the world right now. But it helped happier there. And I'm always quite I'm sort of a happy sort of person. So I can't jump around there. So there's a saying. I've told this about, I don't know, 100,000 people over the arc at my talks. Curiosity killed the cat. Did you know there's a second line to that saying? But stand up. Did anybody else know? Did anybody else know that? So the deep irony of that is curiosity killed the cat. Satisfaction brought it back. So it found out what killed it. Most people go through life never finding out why they're going wrong and what's happening. You know, they just don't bother. It's critical to be curious. Curiosity is everything. Absolutely everything. There's a second saying which is jack of all trades, master of none. Anybody know the second line to that saying? Give you 10 quid if you do. I always thought it was a bit negative thing being a jack of all trades and master of none. But actually, the second line is oft times better than being a master of one. And jack of all trades like polymathic, yeah? Sort of like a bit like Muskie's trying to be, you know, in different industries. So that was interesting. So here I am, weirdly with a crumpled paper background in 1993. And not that bottle of shaving oil, but one similar to it. Well, it is actually that one, because that's the only one there. But no, I'd hand-filled 10,000 of those at the sink to save some money. But I have a weird trait curiosity. I wonder why things are the way they are. Most people don't bother. Let's go through life accepting it, yeah? Like, why is this room mainly grey with a tinge of blue? Quite a nice colour palette. Maybe that's the reason. It's just a nice colour palette. Doesn't really matter. Look beyond the obvious at what's going on and why. And that's where market opportunities open up. Basically, I was very lucky that I created, people have told me, I inspired the founder of Greg Jackson to create Octopus Energy. We have had 15 million pints at a pub in Notting Hill with him, plying me with pints of Guinness, because that's what I drink. Well, I wouldn't have done it without you, because you basically gave me permission to take on the big six. Because you take it on Gillette with a couple of fox terriers, mate. And then there's innumerable others over the arc. So I'm 31 years in now. I was 26 when I was there. And I'm old now. But I try to keep young. Yeah? Do anybody know what Riz is in the Gen Z speak? Have any of you think you got it? You can never ever say you've got Riz, babe. That is for somebody else to tell you you're Rizzy. Yeah, that's Rizzler. I knew. Riz. You got to get down with the kids on the Riz on the TikToks, yeah? Allegedly, I'm told, King of Shaves is quite Rizzy because we hang with Cov. I'm pleased about that. Yeah, it's a shaving brand. Trait curiosity. You've got to keep curious in the world. All this stuff, this is just a summary of like where it started. A bit of King of Shaves that my dad still has, a playing card. We called it King of Shaves. Posters, me. What's that over there? Well, that was an April Fool's joke that everybody thought wasn't. Because basically, over the arc, this is a Nokia 3210 of razors. It is just a boring bit of plastic with a cart on it that Gillette, that was worth 57 billion in 2005, continued to ship it. It cost them 4 cents to make that cartridge. They charge it out at 4 quid. They give Tesco 16 points. And they money gun the hit out of anybody who competes out of them, including me when I did our Acer Razor. Sorry, that's Hyperglide. That's 85% of worldwide market share is theirs. So if you think you're going to go and challenge them, unless you're Mr. Beast or Logan Paul, you are not getting a shot in. Dollar Shave Club blew up, owing $1.3 billion. Harry's blew up, still owes $1.4 billion. Thought L'Oreal was going to buy it. Oh, no, it did not. Who wanted it? They do private label for Lidl and Aldi. Oh, L'Oreal, we are with it. No, you're not buying the Aries. Yeah? They looked at King of Shaves, kind of Wonder Wazar, Mr. King. I'm confused. So don't assume when I meet a lot of founders who just, we're going to raise, we're going to debt, dilute, raise more, A, B, C, D, exit, yeah. 99.9 never make it. Yeah, they just never make it because you're already in debt. Yeah, unless you get your runway down, you're going. So I'm trying not to go through. So all my behaviour has always been challenging why things are the way they are and trying to do something different. So rightly or wrongly, I could have sold King of Shaves. We had the first offer in 1995, 3 years after I founded it, and we had multiple offers going through. But I never expected to be where I was, so I just thought, I'll just keep giving it a shot, Will. I'll just keep going. Let's go up against Gillette. So I'd studied engineering. That is what a razor looks like back in the day. That is still what it looks like now. That's 10 years ago. I just pulled this from my 2014 deck. And that's Hyperglide. And what made that different was it had a super hydrophilic coating on it. We'd patented. He just had it bought and he shaved. So that blew up my market, which is great. King of Shaves. We just sell a lot of razor cartridges, yeah? Brilliant. Raised a load of money off that. And we launched it. But we did all of this. You can imagine going up against Gillette, and we're like, crikey, we're like 18 people in an office. I think I did not have dogs in. But we had a lot of access, a lot of talent. We have a partnership with a Japanese company. Everybody believed in us because they just wanted to, yeah? It was that moment in time that Britain was brilliant. Olympics, go King of Shaves. And this is now a long time into my business. Where are we now? What's happening there? So going back to this was an April Fool I put up called an e-razor. And you basically had this, it sprayed a little fine mist on your hair. And then it dissolved. The hair, it just fell away. Oh. I had tons of inbound on that with people saying, where can we buy this? This is real. I'd had a ChatGPT write a patent application I stuck in the April Fool. Most people just went, wow, oh, he's got that. Oh, my God, we're dead. That's the iPhone killer. That's a Gillette killer. I then looked into it. It can be done. Yeah, you can have chemicals that dissolves. But, eyes this, clinicals that. That's still what the market looks like. On the right, everybody thought the Scarp laser razor was a scam. Oh, no, it was not, actually. There were 5 or 6 companies. I was involved in that. It's all very secret. Everybody thought it was scammy on Kickstarter. Do you remember laser razor? Everybody was shaving laser razor. It raised $4 million. It didn't ship the product. I got myself in there because I knew nobody would take these guys seriously. I knew everybody. And we got one big, massive corporate that put a ton of money into it on an NDA. But then the boys went and valued themselves pre-market at $2 billion because they were so convinced. And I go, no, boys, no, you've got no product, you've got nothing. You can't go $2 billion. Pre-market, pre-product, pre-ship, and these guys are going to spend all the money. So after 3 years, that blew up. That's real pain because I had 5% of that, and the founders were greedy. They're just greedy. So that was annoying. Not many people know that story. They all think Scarp's a complete scam. Well, it wasn't. A famous British guy who makes Hoovers went over in his private jet. So knowledge and know-how, always be curious. Do you know what that is on the right? Come on, ladies, you must know what that is. It's a 400-pound air curler by James Dyson, yeah? It uses something called the Coanda effect. The Coanda effect is the attachment of supersonic air to a laminar surface so it curves it. It is what I did my PhD at Portsmouth, standing in a rig, attaching air to a big cylinder. It was very dangerous. I'd forgotten about it until he launches his, sorry, I've gone fat, curve thing. I thought, if only I'd known, if I'd had that jump to go, ooh, ladies colour hair. It whizzes the hair out of the curler, and he charges 400 quid for it. Probably cost him about, 15 quid to make. And Dyson is a luxury goods manufacturer, yeah? So that's engineering, is that. That is how it all works, basically. Fire it at curve surface fast enough, it goes over it. They use it on planes to get them to take off faster, basically. Now, here we are. Just read it. I mean, we were lucky. We had Jay-Z and Beyonce at our launch of Exceed in his club in 2003 in New York, as you do. Then we went into men's cosmetics. Boomers, all of us, we're pretty easy to market to because we're basically linear. We watch the news when the news is served. The youngsters, they go to watch the news when they want to. Yeah, and they just don't really bother. So we had Will Carling, we had John Terry, we had Bob Scully, we had Olympic stuff there. Now, this bloke, Angry Ginge, easier man, we managed to nab him at Wembley. He's a Man U supporter. He's got 1 million followers on the YouTube. He's got 500,000. Everybody follows Angry Ginge. It's already looking nervous for us at Coventry, yeah? So
Angry Ginge, how was the game today? How would you summarise it?
I just waited for Coventry to show up, to be honest, mate. Easy as that.
Do you think we did well?
No,
Is there anything you can't just diss us like that? Come on.
No. Jokes aside, I think when you were 3-0 down, I thought it was game done. It should have been game done. But you did it the whole FA Cup. You never give up till the end. You brought it back to 3-3, and credit to you. But there's only one team going to the final, and that's us.
From the King of Shaves team, we have a little gift for you.
Okay.
Just for jumping on here.
Yeah, I've got a lighter, mate, so I'll just bear
Here we have the King of Shaves shave cream, 2-in-1. It's like a little moisturising cream. Okay. It's a gift to you for winning the game. Congratulations.
Thank you
so you don't have to rub it in it like anymore.
Yeah. No, I appreciate it. Thank you. But I'll tell you what you need to do for next season. Learn the offside rule. Can't be offside and score a goal, can you?
You can rate it out of 10.
I'll be honest, mate. If I think it's shit, I'll say it's shit.
Yeah, no, say it. You can definitely be honest and rub it in your skin. It's like it's
it smells nice, to be fair. Wow, that is amazing. Honestly, that is amazing. Wow. I will use this, so thank you so much.
Lovely. Thank you so much, bro. Thank you.
Have a good one.
That is how risky you have to be. That could have gone horrendously Pete Tong. We want to post it, obviously, but it's been sad, yeah? I had to get out of the Royal Box to get to that one, and it's a nightmare getting out of the Royal Box. Getting out, they let you in quite easy, but no, easy going out. Come back to this one, sorry. Right. This is quick. No, very funny. I invented retail mini bonds. All right, they're notorious now. They've been banned, I think, now. I invented them with Memory Crystal. We called our ones and names bonds, shaving bond, 0.07%. Yeah, because everybody wanted my shares in King of Shaves. It was private. I said to Leslie Gregory, MC, oh, can't we just do something like a bond? And she said, because I bought shavingbond.com randomly. I forgot to tell you I bought shave.com for 18 quid in 1994. And we did. But that then triggered people who then used and abused it, like 237 million financial scandals. Wasp crashed their stadium with it. They did a Wasp bond. They defaulted on that, 95 mil. It went out of control. It went out of control. All we used it to do is we want to bring people close to our brand, give them 7% of what they lend us, copy of my book, and a bit of free product. And it then became ripped off billions of value at retail investors. Stop, I think it's been banned now. I invented that 2008. So it's sad that, because I've cost a lot of people a lot of money by doing that, but it was done for the right reasons. But then it gets abused. So watch out for being abused, yeah? With clever ideas. FA Cup thing, so basically my brother owns Coventry City. Doug King, nobody knew who he was. He would tell me, don't tell anybody who I am. And then he goes and buys a club. Like, out of the blue, nobody knew. Yeah, nobody in the family. We get a WhatsApp message to me and my brother Pete. Just bought Coventry City, lads. Scary emojis, 3 of them. He's put 130 million in so far. He's written off all the debts. He's loaded club money at 0%. He's executive chairman. He goes to every game. He's my middle brother. I'm the sort of cleverest, smartest, but nowhere near the richest. I used to be the famous one of the King's families. Now I've dropped to number 2. But he said, right, get your shave front of shirt sponsor then. Let's go. So that's why we were at Wembley on Sunday when they went out on penalties. And this was my post-match interview.
What are your thoughts right now, Will King?
What an incredible game. 4-3 up, disallowed by VAR, questionable. The fans were absolutely incredible. I mean, Manchester United fans were silent, as far as I could hear, and Coventry fans were off the scale. For me, as a sponsor of King of Shaves, it was a little bit heartbreaking, but it was a joyous occasion. Everybody within the community can be proud, and I know Doug is proud of the team, Mark, the fans.
What's your vision for the future? What can you see the club doing in the season coming up?
Doug is executive chairman of Coventry. He wants to win because nobody wants to lose. It's all right to not win, and there we are. This is what we need.
And this is what we mean.
What we need. There was a lot of energy.
Yeah.
3-0 came back, and it was a joyous game to watch, wasn't it? I mean, that'll be all over, not just the UK sporting media, that'll be all over the world. We're all obviously not as high as we could be in terms of our relation, but hey, that's football.
Onwards and upwards.
And believe.
Thank you so much, Will King, for joining. Yeah. You can find King of Shaves at...
So that I mean, that's crazy, yeah? No, I mean, it's been the most surreal 2 years. It's been the most surreal. I was with him on... no, I mean, there's... We went to Wembley last year, went out to the playoffs, getting to the Prem. So he's lost 2 Wembleys, 2 playoffs, 2 Prems. Went back to his house, had fish and chips, me, him, his wife and his dad. And Dad, who's 91. But truth is stranger than fiction, yeah? No idea that was going to happen. It's happened. No idea we're going to be involved. We're involved. 9 out of the 11 players got beards. What can you do? To just summarise, sorry, it's this thing there. Just carry 2 torches going forward if you want to be, I believe, successful in life. Curiosity, yeah, just be curious. And the second one is responsibility. I hate sustainability. It's all suspicious. I hate words being in the SUS. Dodgy, yeah? There is never saying, with great power comes great sustainability, you say. No, there is not. But with great power comes great responsibility. And I know, a huge organisation like TCS will understand their responsibility to the planet. Sustainability is just a greenwashy sort of word, hate it. So they're your guiding stars. And, nothing starts without sale, remember, ladies and gentlemen. And my way of getting a bit late selling, they hate selling. Oh, they're salesmen. Always be closing. I was known as 3-ring king when I started my telesales career off, because I wouldn't let him ring 3 times in case it was my hand off the head on the phone wanting to place an order with me. So all I say is that is sales is just transferring your enthusiasm for what you sell, make or do and explaining why it's worth the cost to the person you're selling to. But it's transferring your enthusiasm for what you're doing. That's not selling. That's just what I'm trying to do with you at King of Shaves. Sorry it's run over. Nobody got the dead cat. Well, one lady got the dead cat right, but she knew it. But the satisfaction of the knowledge to know what killed it, if only Nokia had that knowledge when it had 72% worldwide market share in August 2007, had it been curious about touch screen phones, maybe having put a little music player in there and put a bit more effort into the camera, they wouldn't have had their Kodak moment, would they? Thank you very much.
You've got the clicker to move the slides on. Have you stolen it? Right. So you're a tough act to follow anyway. Don't make it harder. Yeah.
That's what I'm not. This is what you do. It's very different. I love telling that one.
Yeah. Anyway, well, there's a bit more than that. I'll tell you. So I spoke to David a while ago, and he said, "I'd like me to come to this and talk about challenger brands." And I've got quite a lot of experience, observation, because a bit like Will, I'm old now. But I've worked for a number of brands in the packaged goods space, and I've got a few observations as to what works and what doesn't work, and how one might build enduring value by being big, or how one might create value by being a challenger and a small brand. So let me do that. But I have to say, it is a small world. Will, I'm a Wolves fan, and at the 93rd minute, a few months ago, or not 4 weeks ago, we were all signaling we're going to Wembley. So we were, and then you scored 2 more goals, which you well deserved actually. It was once again also a great game. So it was fantastic.
Incredible support as
well. So, good. So as I look at it, I'm going to talk about food and drink. I'm not going to talk about technology because I think some rules change in technology. I think if you're in a tech brand, inventions can really disrupt things. In food and drink or packaged goods, that's rarely the case because the technologies are pretty well established. In most food and drink categories or packaged goods categories, there's a dominant brand and you get a number of smaller challengers. The dominant brand, the big brand, should have higher gross margins and higher operating profits. Now why is that important? Sounds a bit dry. The reason is because you can invest that superior gross margin into fixed type investments that make it very difficult for a challenger. So for example, you can have more money spent on R&D to create a stream of innovation, which means that private label is always going to find it a bit difficult to go and follow. You can spend more on marketing. You can get to consumers more. You can get to customers more. You can spend more on sales. You've got to be seen to be sold. So if spending money on people that can get your products visible is also important. And what you really want to do is position the challenger as a me too but cheaper. And that's a brilliant place to be. All they can do is make your life a bit annoying by discounting more, but having maybe a similar-ish product quality but never quite as good. But but a lower gross margin, so all they can do is use price as a weapon, and in the long term that doesn't work very well. It doesn't make huge amounts of money in average. So being big is great. And just my personal experience, I was at Walker's Crisps for many years, 15 years, went through, joined as a marketing manager, went to running the company from 1998. That was a great example of a business that grew with an insurgent's mentality. Walker's Crisps was a pork pie butcher's shop in Leicester in the 1950s that sought to diversify into potato crisps because it got a lot of people coming back from World War II, being demobbed, and then got enough work to give them. They got into crisps and they discovered, that actually quality really mattered, and that if you sold a crisp fresh, it tasted a lot better. And they were up against much better capitalised competitors like Smith's and Golden Wonder, owned by big multinationals, who all just couldn't wait to sell very hard, discount, have big stocks. And the Walker's success in its early 2 decades was slow distribution gain, because it knew that if the product was fresh, it would sell faster and be better. I got there, it was just about 25% market share, just about leader, and Golden Wonder was sort of nipping at the heels. And the next 10 years was spent really trying to create a position of dominance. Now, you don't like to say dominance because we did get investigated by the Mergers and Monopolies Commission at one stage, were cleared for about abuse of dominance. But that was an example of learning to throw your weight around, spending money on technology to make your product consistently better, spending money on marketing to make sure it was consistently in people's minds. It's an impulse product. Spending your money on R&D so that you're driving your competitors mad because they could never, ever keep up with the stream of innovation. Now, innovation in the world of crisps is not probably what it is in the world of Tata Consumer Services, right? We know that. But little changes to things that mean a lot. Walker's Sensations, you may have heard of that. That was our answer to kettle chips, but 10 times the size, higher gross margin. How do you keep trading up? So if you're a dominant brand, you should never lose it. You should keep investing. And PepsiCo had a great phrase, actually, or saying, which is like, act like a number one, act like a leader, but think like an insurgent. Always be challenging yourself. A few things that, what you heard from Will. Now, Fever Tree and Schweppes. I love this story because, as a PepsiCo man 15 years, I love to see Coke having messed up. So Schweppes was the dominant leader in tonic, in mixers for years and years and years. It still is. But in tonic, the flagship, it lost its position in the UK to Fever Tree. How on earth did they let that happen? And they let it happen because it became part of a conglomerate. The people, I think, running Coke didn't really understand the detail of what it was to continue to be excellent in mixers. It failed to innovate. It failed to try and dare to cannibalise itself. Or if we do it like this, it might slowly affect our core business. So it can be lost. Number one positions can be lost, but it's a crime. If you're a number one and you do the right things and you keep investing and you think, like a bit of an insurgent, but with the kind of the scale in mind, you should never lose it. But it can be done. And then forwarding today why I'm here, I've been chairing a company called Chapel Down. We're the number one in English sparkling wine, but that's a small category. I'll tell you a bit more about that later. And our role in life is to really get English sparkling wine thought about in the same sort of moment that you might do if you're going to buy champagne. So our category is a challenger category. Our brand is a challenger brand. And a little bit about it. You'll see from here, just a video about us.
This is from Chapel Down in Kent. Nice. This is one of my favourite English sparkling rosés. Yeah.
That's equally as good as a bottle of Moët or a bottle of Bollinger.
Absolutely.
The Chapel Down Group have become the official sparkling wine of England cricket.
Very off.
They race over the straight mile for this Chapel Down Classified Stakes.
Please enjoy spraying the Chapel Down English sparkling wine all over yourselves.
So that's a little bit about who we are. It's a little bit corporate. I get it. Thank you. I'm now going to get under the surface a bit about where we need to go, and sort of, I do believe that in your challenging, you need to get the basics right, but you need to think in a different way. A little bit about the industry, the sparkling wine industry. The English wine didn't really exist properly till about 25, 30 years ago. There's lots of hobby producers who tend to grow German grapes because the climate's more like Germany, which resulted in sweet wines, which actually was going massively out of favour. And then a few people with insight had the courage to start planting champagne-type grapes, so Chardonnay, Pinot Noir in particular, because they kind of noticed that the soil in Champagne comes under the English Channel and re-emerges in Kent, and global warming is our friend. So the temperatures in the Champagne region, or rather the Champagne region, is way hotter than it was 25 years ago, and in Kent and the south of England it is warm as it was in Champagne 25 years ago. So actually, if you grow the grapes properly and you do the Champagne method in the right way, you can produce very good quality wines. And it moves from being like I said, sort of a hobbyish sort of Camera, the kind of campaign for real ale, kind of like real hobbyist type thing, into a mainstream. Actually, you can make really good sparkling wine. Now, that said, you can do your own reading here. I'll shout out, but sparkling wine is about 220 million bottles sold in Britain every year, most of which is Prosecco. So people like sparkling wine. Prosecco is very big. Champagne is also large. English sparkling wine about 7%. So we're tiny in the scheme of things. If you look at price points, we're probably closest to Champagne in terms of how we sell. So, you get a big enough share of that. But it's still a growing category. It's growing like crazy. It's the biggest in Kent and Sussex. It's the biggest source of agricultural growth, particularly since post-Brexit and post-CAP. A lot of people are going into growing grapes. We like to think of ourselves as the heart of consumer trends, so it's not easy, but we're pushing a moving target. So provenance, you talk about sustainability early on. I mean, I don't think you sell high quality English sparkling wine to compete with Champagne by saying, look, buy us because we're local, but it helps. We clearly, the big emotional need state for buying sparkling wine is celebration, so we can kind of tap into that. Spending on tourism, and once again, wine tourism is growing. We're not Napa Valley, we're not the Champagne region, but it's remarkable how many people will visit vineyards. We get 170,000 visitors last year, so it's big. And you can use social media to tell the story, as was said. Now, this is probably the point to the presentation, which is about challenge. So our mission, and I joined the business 4 years ago, we were a little bit confused. We had sort of gone into volume. We sold more still wine than sparkling wine, which actually isn't where the money is. And I come back to kind of thinking like a leader. So Champagne, I think, is brilliantly managed, that industry. They keep their prices very high, by the way, but they keep their prices very high. They operate more like a spirit than they do a traditional wine. Wine's normally difficult to be in. Sparkling wine's brilliant. Champagne, consistent quality, high prices, which they invest massively into awareness and building. So we needed to think in a sort of more aggressive way, I think, to take our increasing share of part of that market. So our mission is to change the way the world thinks about English wine. Because trust me, most Brits I meet, you might get one, half people say, yeah, I've kind of heard of English sparkling wine, half haven't. Do you? I sit on the board of a company that's partly owned by a French private equity company called PAI. And the first time I mentioned I was doing Chapel Down, the French guy just laughed. Wait a second, because he'll get his comeuppance. But so we do have to have that insurgent mindset. You know, we're not selling on a patriotic card. I am patriotic, but I'm not jingoistic. I don't expect people to buy our product just because we get made down the road. It's got to be really good, but actually it is really good. And so that's our mission. We want to change the way that people think about the sparkling wine category. And then within that, we want to be and continue to be the leading and most celebrated and famous English winemaker. And we've got largely that going for us. We are the biggest one. We're growing really fast. We're putting a lot. It's very capital hungry. So kind of one of the themes is, you know, how do you raise capital? We've now got 1,000 acres of grapes under vine. We don't, and then we've also got a number of acres that are contract as well. We don't own all our own stuff. That's expensive. Property prices in the south of England, you know, thankfully nowhere near as expensive as they are in Champagne, but it's going there. We make great quality wine. The international awards are important, that they are an independent sort of verification of the fact that you can compete with the very best. We bought, it's a fixed cost game. We've invested quite a lot in sponsorship to get visibility. So cricket, you saw mentioned in the film, the boat race, and Ascot racing. And guess what? And it was a kind of brilliant innovation and insightful idea that I brought to the business. It used to lose money. Why? It's not a tech company. And now we make money. We're the only profitable scale English winemaker. And it wasn't that difficult. What do? You focus on gross margin. You focus on the mix, the product thing that can make you most, and what will make you famous as sparkling wine. We've got a portfolio where we cover basic, the entry level, the Chapel Down Brut that you can get in most supermarkets is our real workhorse. It's excellent. They're all excellent. I'm not going to overdo the sale here, but we follow the traditional method of price segmentation that the big champagne houses do. You know, entry level, premium, and super premium. And we also have a range of still wines, a Prosecco-like one, which is the bottom left there. A number of still wines which are good, but still wine is just harder work. It's just harder work to compete in. So we make good products, but it's a harder business. Champagne or sparkling wine is the way forward. This is important. We have an excellent. Our head winemaker was voted head winemaker of the year. 28 awards last year, and I say that not to be boastful, but these are table stakes. Unless you're getting these, you can't have a conversation with a senior buyer. Because you're not doing this. This is not an emotional story. This is a product-based story. We compete very well with the best of international sparkling wines, and this is objective proof. You have to keep spending money on promoting, as I talked about. One of the challenges is, David knows this a little bit, where the category designation, we're not allowed, even though we make the products as a traditional champagne method, we cannot call it champagne. And if we were to call it champagne, we would be attacked by a legion of well-tooled up French lawyers, understandably so, because that's what trademark means. But it's a bit difficult. And I've been pushing the organisation to maybe come up with some more challenging things. At the moment, we don't need to. This seems to work in terms of a fresher way to celebrate. I hate to go back to my Pepsi days again, but let me tell you a little bit about sparkling wine. That the maritime climate of England makes for a sparkling wine or a champagne type wine which is a bit fresher and slightly more astringent than a typical French champagne, because it's got slightly fewer days of sunshine and slightly less warmth in the grape. So you tend to get the slightly fresher taste, which actually for people under 40 is their preferred type of sparkling wine. So I don't want to quite say it's the taste of a new generation, but there's something in that. So a fresher way to celebrate. It's important, folks. It's important. Is important. Now, I'd love to. We toyed with copy that said "Chapel Down English for Champagne," and we're told by our lawyers you're bound to get a challenge. We are going to do that at some point, and I'd like the challenge and the PR that goes with it. But you can be a bit more subtle about it. And social media is mentioned. Take a look at something we did recently.
Qu'est-ce que vous diriez si je vous disais qu'il y en a un qui est un vin pétillant anglais?
Ah!
comment ça va? Welcome to Reims, the world famous Champagne region of France. Le premier verre. Ouais, c'est agréable à boire.
Le dosage est parfait, les bulles sont fines.
J'aime trop ça.
Je sais pas comment ne pas aimer champagne.
Ah, il y a des gens qui adorent. Qu'est-ce que vous diriez si je vous disais qu'il y en a un qui est un vin pétillant anglais?
Incroyable.
C'est un vin pétillant anglais de la marque Chapel Down.
Le premier, il est plus léger, je dirais.
C'est plus frais. Le premier, pour moi, est plus agréable. Il est assez franc.
Plus parfumé le premier.
Donc les vignes sont en Angleterre.
Exactement.
Tout est fait en Angleterre.
Oui.
Dans quel endroit?
Le premier.
Premier.
D'accord.
Bah oui, le vin a gagné.
Et celui-ci me bluffe parfaitement.
So you kind of get the idea. It is trying to think like an insurgent. You have to do it a little bit cleverly. All that really cost us was, the effort to go out to Epinay and make that film. And social media can do the rest. And it's all part of that drip feeding of trying to get more penetration. People that might think they're in the market for champagne to think about English sparkling wine or Chapel Down in the same breath. And we're blessed with having some very good English sparkling wine competitors. Nye Timber would be the probably most obvious other one, who make fantastic product. So every experience you get of an English sparkling wine is a good one. Just briefly to finish, we'll go to questions. You've got to be seen to be sold. This is still largely an impulse product. We're more in the off trade, which is the supermarket trade, than the on trade, and that's given us the visibility that we like. But where the on trade is a fixed cost game, we need to get more salespeople there. So the more, the better the gross margin, the more you can afford it. Export's tiny. So if it's a story to tell people about English sparkling wine, if you're growing up in Kent, then what chance have you got with somebody from the States or whatever else? There is an export market. We are organising to tap, but it's a small part of our sales. And to be honest, we could sell. We're supply constrained at the moment. We could sell pretty much everything we could make in the UK. We cover all trade channels. Highest awareness and conversion from awareness into penetration, highest off-trade market value. So in summary, and I'm just going to finish up by giving a bit of a plug for brand finance, but we are the power brand in English sparkling wine. We've got great momentum. We're profitable. We can see our way to keep growing. The next challenge is to build a new winery and we do what the French do, which is basically French have a lovely little kind of like touristy kind of winery, but all the volume's made on the ring road in Reims, it seems to me. So we need a similar thing. We've got our planning permission for a new winery. It's had the third challenge. It's now in judicial review. So you talk about the problems of economic growth. That's one of them. But we are very well placed to continue to grow. It's capital hungry. We launched on AIM in December last year, and that's done very well for us. I think retail investors rather are starting to understand the proposition better, but it takes time. You're talking about a 5-6 year payback on a winery in a short-term environment is one of the challenges. But we're buoyed up by the fact we're growing, and one of the other interesting things is we're now seeing a number of the champagne houses buying land in Kent, which will make our proposition, it's more credible, but also makes it a bit more difficult because, and this is an observation from David, if you're, Laurent Perrier, you don't need to call yourself champagne, everyone knows what you are. So if you're making that in England, and you have a little designation English sparkling wine, no one will care. So we've got to be thinking about that, but that's probably a sign that we're being successful and we're causing problems. And the little plug for brand finance, so not only David's very good insight in that, but we did get the brand valued. I thought it was worth it. I don't think it's a tool for raising capital ongoing. I think it's a reassurance. It's probably something, if there were ever to be a transaction, which we're not chasing, would have some value. but it was a worthwhile exercise to do. They were very challenging. This is not a patsy kind of operation where, yeah, tell us what the number is to be. And we found the exercise of going through that very good. So if you are in that position, they're very well worth talking to. And that's my story. Thank you very much.
So I use my chairman's prerogative to ask this question. It seems to me that celebrity endorsement is the way that a lot of drinks products are really skyrocketing. I mean, are there people like Tom Cruise or Taylor Swift or any of these famous people that like Britain? I haven't seen any of them present in your marketing. Is that because you can't afford it, or?
Yeah, it's I mean, so celebrity sells. I brought Gary Lineker into the Walkers fold in 1994. So it's clearly a shorthand for things. I think it's definitely being thought about. What would the right type of spokespeople be? But we haven't got the heft for national TV media. We could do it online. The kind of Tom Cruise bit is almost, could you get them in as a minority investor? A bit like they've done in sort of some other areas, and say actually kind of come in along and be part of the journey. But we're probably not quite big enough yet to get their attention for that kind of level. But there's lots of celebrity type endorsers that we're looking at that can sort of just create that momentum within the social media world. But I think the kind of the Taylor Swift would have to be come in and be an equity partner and enjoy the journey. Thank you.
Are we doing any other questions?
You're cool.
Is there time for one?
Thanks for that, Martin. I thought that was fascinating. I just wanted to ask if it was a deliberate tactic not to put a geographic indicator on the bottle.
Yeah, well, we do now, but you probably didn't see it because we haven't, and it's a very astute observation. If you go back, and I think there'll be a few bottles outside. Not for general release, but we now say on the neck sleeve Tenterton Kent. So that's kind of that's what we're doing to kind of elevate that more. So just keep it. It's got to come from somewhere. It always did, but the English bit is made more relevant if you say where. So that's we have done that belatedly.
One more, Julie.
Lovely. I can't wait to taste it. You've got me sort of really interested. Question, I remember the Crystal story where they were supply constrained and they elevated prices and went, super premium.
Yeah.
And I saw that your high end was like the 120. You mentioned your supply constraint. Was that a deliberate strategy to keep it broad based, or was there a scenario where you would go super premium?
Well, we do. We don't do much of it. So we're still young. We haven't got huge amounts of stock. So what they can do in champagne is just lay down, litres and litres of the stuff, and that allows you to pick your price points. The volume for us is in the kind of £25 to £30 bracket. We do the super premium, perhaps the single vineyard ones, single vintage, just to demonstrate our credentials in the on-trade at the premium end. So it's more of a shop window type thing. We don't expect to get rich from it. And over time, so it was said on the chart there, on the film there, bizarrely last year was a record harvest, even though you remember that June and July were awful. All the buds had grown by then, and it was perfect. So it was 70% higher than the previous record. Great for the whole English sparkling wine industry if you've got the money to put it into stock. So thankfully we have, but that allows that extra stock pressure allows you to do some different things at the higher end to kind of put more stuff down. But it's a marketing tool, if you like, rather than an economic driver. It demonstrates credibility.
Thank you.
Thank you.
That's brilliant.
Hi, everybody. My name is Brandon. I've been really excited to see that presentation for a while because I was married in Napa Valley. I went to business school with Digby Wine founder, Digby English Wine. My best friend is the founder of Vagabond Wines, which you may know, self-service wine beer. And I have been overserved at Chapel Down in King's Cross a couple times, so I have a strong affinity for it. It sounds like there's a chance for today. I presented here about 6 months ago And David asked me to come back and make a presentation, just an update on our progress with raising financing for Big Black Box. So I'll take you through a couple slides. For those who are here previously, I apologize. There's a little bit of duplication, but there's some kind of new angles on where we've gone and how we've done. My background personally, so I started a burrito chain. I came over to the UK in 2003 for my MBA. I started a burrito chain after that, after running Arcadia's e-commerce division and trying to convince Philip Green to invest in technology. So that burrito chain is called Tortilla, grew it to 15 sites, I remain on the board. We IPO'd in 2021 here, and the business continues to grow. But the team that invested in me from a private equity firm called Quilvest left the management team to start, actually it was a family office, to start a private equity firm called Trispan. So we've invested in Thunderbird, Rosatai, Pho, and Mowgli. You may have heard of some of those restaurant chains. And that's given me a lot of access to information about restaurants, but also consumer experiences generally. So I have brought these guys every great competitive socializing business. If you know what competitive socializing, so it's the golf and flight club and Clay's and things like that. I brought them loads of things to invest in, and they have passed up on every single one of them. But I still remain a kind of a believer in the change that's happening in leisure. And I want to take you through some slides on what's transpired with all that. This is a slide just showing the decline in the number of pubs over the last 20 years, 23 years really. There's a better stat, but I can't find the chart on it, which actually says that in 2003, when I arrived in the UK, there were 144,000 licensed premises. There's now 99,000. We've lost a third of licensed premises. And where have those people gone? What are they doing instead? Well, what we've realized is that there's been this huge disruption in the property world kind of generally, and therefore in the operating vehicles that kind of underpin them. If you think about what people are doing with social media, so you're catching up with your friends online already. You have Facebook, you have Instagram, you already know what your buddies are doing. You don't really need to sit down across from a table at a pub and have some mass-produced beer instead of some great English wine, and to have and catch up on what people are doing. What they want instead is they're already caught up. They want to have a shared experience. And so things like competitive socializing are booming. If you look at, so urban mini golf, I think everybody knows, places like Putt Shack and Swingers. If you haven't been to Swingers in the city, whenever I say Swingers, I always just like, but it is a great golf venue, and they do unbelievable numbers. And importantly, their return on capital is twice what any restaurant chain would love to have. So usually things are 35, 40% EBITDA divided by CapEx in the restaurant trade. They're kind of more like 85%. It's a great business. Stop the Clock is escape rooms. Even bowling, old school, terrible use of space, low sales densities, still increasing in size. And what's amazing, and kind of oddly compared to the slide I'm about to show you, virtual reality has actually kind of trailed off a little bit. But the point is that people want immersive experiences, they want shared experiences with their friends, and this is where things are heading. Passive involvement in leisure is waning a little bit. And the challenge for cinemas is even worse in a way. So in the same way that social media has kind of disrupted the pub industry, even more directly, as we all know, streaming video has disrupted the cinema industry. And this is a broader thing with e-commerce disrupting retail and all these online channels coming in, causing challenges to the OpCo world, and that's having an impact on the property world, especially for inflexible assets like cinema buildings, which are oddly shaped and kind of not easily repurposed into a hotel. An office building is, but not with a cinema. I think we all know about this kind of trend with Netflix and streaming video just kind of generally, obviously hitting kind of a low point in COVID, but has not recovered. And it's not, of course, just the UK. It's also global box offices. What's replacing it is people going to immersive experiences. Now, this chart doesn't show anything about global touring exhibitions, but global touring exhibitions, which you may have seen these, everybody's kind of heard about the Van Gogh exhibition. If you know Lightroom in King's Cross, if you haven't been, you should go. They're just getting going. They had the Hockney exhibit, now they have the Tom Hanks Moonwalkers exhibit. The next set of IP is going to be kind of jaw-dropping. They're focusing on global icons, and they're focusing on storytelling, and it's just amazing. But places like that, Places like Frameless, places, the exhibitions like Jurassic World, where they have 9-meter tall animatronic dinosaurs that scare the kids, and other types of exhibitions, those are burgeoning, and they're burgeoning because the film and TV folks, much less the heritage folks, much less the artists, they want an omnichannel approach. They've got their gaming, they've got their merchandise, but this is exhibitions, and it's real world, and the emotional connectivity and the interactivity and all those things is really kind of booming. And so this is all exploding, but so is global touring exhibitions as well. And despite all that, despite the change, what the property folks are doing is they're looking at the old world stuff and they're seeing, well, cinemas aren't doing great and gyms are a little bit shaky and some of these classic leisure things that they're very exposed to aren't great. We're not going to invest in the future. We're just going to kind of say leisure's a bad idea. It's not a bad idea. There's some great opcos and some great new concepts that have ridiculous returns, way better than cinemas have had historically. And therein lies the opportunity. I met up with a gentleman named Tarek Jones a couple years ago. I was working on a concept to develop a department store into a department store of experiences. He was talking to me about cinemas, well, specifically talking about his work at Venue Lab, which he founded. He ran all the events at Battersea Power Station before it was refurbished, and at Printworks, along with 10 other venues. And he said, Brandon, I've got these kind of crazy things. I'm dealing with corporate events. People want something for a weekend, a couple of days, it's a concert, whatever. But people are coming to me and they want something for 3 months or 6 months where they're going to put in these global touring exhibitions that are exploding in the States. He's like, in the States, it's pretty easy for them to get sites because there's lots of land in the States. And there's lots of derelict or empty retail parks where you can just take a warehouse and just drive to it. Everybody drives to everything. Here, you got to have something in the center of town. It needs to be next to the transport hub. It needs to be 7 meters tall, and it needs to be 20,000 square feet. Sorry to mix my imperial and so forth, but and do those exist? They don't. But that's how things in Europe are kind of structured. It's much more city dense, and everybody's taking public transport. Nobody can get any sites. All these guys have productions that they are representing with National Geographic, Disney, Warner Brothers, you name it, all trying to monetize, much less cultural heritage and so forth. And the ones in red are the ones that have toured to London. All of them looking for space, can't find any space. It's kind of crazy. When we talk to the CEOs of these businesses, this is what they said, either in press or in person to us, representing a whole range of different categories of folks. So we've come together. Colleague Tim is in the back. Tim has 40 years of experience in the entertainment industry, knows a lot of these folks that have the IP, knows a lot of the producers, together with myself on the kind of hospitality and commercial side, and Tarek, who's on the left here, on the property side. Nobody knows about running events. Well, not many people know about running events like Tarek does in this country, to come together to find places for these producers to go in and tour across Europe. We've brought together a huge number of advisors here, and I won't go through all of them. If you're not watching Dorothy DiStefano on LinkedIn, you should. She's one of the top 5 kind of most followed people. She puts in some art exhibition stuff that I just look at, where it just blows our mind. In fact, we didn't know her before this whole thing, and we finally just reached out because she's just so damn cool. So where are these global touring exhibitions? Where are they trying to run? Well, they can't really go to stadiums and arenas. They can go to museums, and when they're desperate and when it's really not about making the money, it's just a marketing play, like if you're doing Formula One, then they'll go to a museum, but they pay stratospheric numbers. Too hard to get into retail, and they want long leases. And if you think about what we're trying to do, we're trying to take a 20-year lease and then chunk it up into a bunch of little leases. Co-working works that way. That hasn't been great, so it's a tough positioning, but it does kind of work from that standpoint. Exhibition centers, well, we got Excel. It's way out there, and there's no real follow-on activity. So it's not ideal, but people have been doing that to date. Theaters, conference centers. We identified a couple of places that we thought would work really well. And when you think about cinemas, so cinemas have a use that's in decline. They are incredibly hard to repurpose. Again, you can't really change that. You got these big boxes, and they're kind of oddly shaped and everything like that. As a result, the rents are incredibly low. The capital contributions are incredibly high because there's nobody that actually wants a cinema, but they do want the tenants, so especially in the shopping centers, because it's going to drive footfall, and then they can go on to spend money in other locations. So they're a perfect opportunity for repurposing. If we can get 16 of these where people can take an exhibition, bring it to London, which is where the Americans want to go first because we speak the same language, and then take it to Paris, and then over to Germany and down to Spain and so forth, that's perfect. Minimal downtime, same set of people that they're talking to, one point of contact, consistent kind of AV and so forth. It'd be great. We've managed to secure a first site. We're very excited. For those of you who know the Sony Center in Berlin, it's now called Das Center because they're trying to come up with a new name, so they just called it the Center as an interim. It's very German. I hope there's no Germans here. And that's in advanced legal. So this is a cut through. Without taking you through the whole thing, there's a kind of lobby and you go down and you walk across this unbelievable sky bridge that's hanging through box 7 and into this area where you have multiple different floors. And if just to point out this is a very cool floor because that's where you can see the cinema projectors that are projecting down. So we took half of an IMAX, 40,000 square feet with, I think, 9-meter ceilings at certain points, and have signed up some great producers to produce that content. We are partnering with Lightroom, so we will have a Lightroom in Berlin. We're basically taking the exact same aspect ratio, shrinking it down a little bit, and then sticking it in there. And then we partner with Bikini, who represent all those folks that you see there, but National Geographic is the big one, and we're going to put on Tutankhamun and then a follow-on set of activities. And we have an LOI from Netflix. They are taking Squid Games and turning into not a real-world game, but a game that's non-lethal. And the visuals on the whole thing are kind of jaw-dropping. The returns are incredible. If we were to do 1,050 tickets per day per exhibition, which is less than what these guys are doing with Peking in Vancouver and Boston, and with Lightroom in King's Cross, we will have a 53% return on capital. If we do 1,200 tickets, we're going to have over a 90% return on capital. That doesn't happen in hospitality. It's a great model. Unfortunately, investors don't see it quite that way, but we'll come on to that in a second. What's really amazing is if you can get some scale and you can develop a covenant, a strong covenant, then you get into the world of big boxes and what happens with landlords. And if you think about it, and it's kind of amazing that folks in hospitality haven't kind of gravitated into the world of big box. If you're a hotel operator or brand, the landlord pays the capex. If you're a co-working business, the landlord pays 150 pounds per square foot of Cat A fit out. If you're a members club like Soho House, they don't pay the fit out anymore. In fact, if Soho House takes a site, the landlord pays the capex, and Soho House gets 25% of the uplift in the value of the underlying asset if it gets sold. If you're Time Out Market, they started off. They wanted to monetize their brand, right? And they wanted to. So we know all these restaurateurs, and we'll get a venue, and we'll set it all up. I don't know if they didn't run their numbers, but food halls are a terrible business. They're 15 to 20% return on capital business. I have good friends. Commercial director of Time Out Market is a good friend of mine, and we know that from market halls and some other businesses. Hope there's nobody from market halls here. In order to get that to a 35% return on capital, i.e., in order to double it, they get 50% capital contribution on the fit out. It drives huge footfall, but they're not great businesses. And that's why Time Out Market has moved from owning their venues to then having a management fee, which is really a franchise fee. And so the landlord pays the fit out. So you get to big boxes, and suddenly it's not an asset light model, but it's, from our standpoint, it's a capex light need, especially when you think about retained earnings, bank financing, and so forth. And therein lies this great opportunity. Super excited, going to go out, going to raise a whole bunch of money. We need 7.8 million euros to fit out that first site, including working capital and deposit and so forth. It's taken a long time to get here. Why? Because just getting a site is a real challenge for any of these opcos, whether they're the cinema, folks replacing cinemas or retail or whatever. If it's a new concept, you have a challenge with the valuers because of yield. So what are landlords looking for? Specifically, what are valuers looking for under pain of death for the landlords? They want strong comparables. So they want a use class that already exists, and they want you to already have been operating somewhere. We're new. It's a new use class. That's not what we're trying to do. And so the yield is, if you have a great comparables and you have a strong balance sheet and all that kind of stuff, your yield is low, and that's good. New concepts, we provide no comparables. We have no balance sheet. We're entrepreneurs. We're focused on finding gaps in the market and exploiting that. Valuers hate that. And there lies the disconnect and really the reason why the high street is a bit of a mess. There are solutions, they can't get any traction just to get a property. But the real challenge is then in the investment world. Let's say you get a site. And apologies for those that have taken through this previously. But so for the venture capital guys, when I started Tortilla, I raised £435,000. I had to go to 40 people to get that money. It was hard. We approached 70 people, got a 4/7 hit rate, so whatever that is. Hard to cobble together 7.8 million euros. So you got to go to the bigger guys. And the private equity guys, of which many in the kind of hospitality world are friends, colleagues, mates, they're like, Brandon, love it. Come back when you got one. Just come back when you got one. I said, okay, cool, but what about this first one? So that hasn't worked for bulk standard, LP-driven private equity firms. Property investors, we thought, this is amazing. These guys, we can just take over all these cinemas. These property guys are going to love it. Brandon, this is fantastic. Come back when you have a freehold, and we'll do it together. Can't you just invest in the OpCo? No, got to have that freehold. And so it's really left with the family offices. But the family offices at the moment, when you go to them and say, I'm working on a UK-based discretionary income consumer proposition, it's crickets. So then we started, so we've been waiting for a while. I've jumped ahead. So we've been waiting for a while before we've gone out for really the kind of hardcore investment because we want to have everything lined up. We need to have the property. We need to have de-risked it. In this kind of investment environment, no risk, as little risk as possible, just on the execution itself. And then you start thinking about the strategic investors. And so we've gone out to a couple and had a conversation with one of the largest cinema chains. And they're like, well, we could repurpose some of our property into this. And we've been looking at this for years. And we know that we've got to do something. And so this is really interesting. We talked to the ticketing guys. And they're like, oh, my goodness, a whole new channel. Fantastic. Let's have a chat about that. And we're now engaged in a number of those kind of discussions, which we're excited about. And now I've kind of ruined the next slide. But anyway, and subject matter experts. There are folks in the entertainment space. They're seeing this. Especially the guys in Hollywood and kind of in that whole production world, they are aware of this change and they love it, and they're aware of the challenge with getting property, and so it's almost emotional for them. It's not just that they're kind of familiar with it. With the private equity guys, you got to educate them. Well, here's how it all works. They're like, I got to talk to some folks and just validate all this. There are those that just know it's correct. So this is where we're at now. And final slide. But just to update you, we are having conversations now with ticketing firms. They're super interested, and we're excited about that. Cinema chains, obviously, for the repurposing of sites. Theater owners. We're seeing Lightroom is funded by a whole bunch of theater folks. They get that this is the next stage. And they love the kind of, if you will, kind of live entertainment, right? But at least it's live in the sense that we're there in person, right? And they see the ability to kind of skip or leapfrog the cinemas. If you think about the evolution of all this kind of entertainment, there was theater before there was motion pictures. Then somebody created motion pictures, and they were like, oh, let's just project it onto a wall. And now what we've got is 4 walls and a floor projecting. Van Gogh wasn't a good example. They just did projection. Lightroom's come around and said, great, we're going to do projection, but we're going to add on storytelling. Then you have other places like Frameless. We're going to do projection, not going to do the storytelling, but we're going to have interactivity. When Van Gogh's paint strokes fall on the floor and you walk around, my daughter walks around, it picks up the strokes as if they were leaves. That's pretty magical. And then the next thing is props. If you can have those 4 things, you have an experience that is unbelievable. It's emotionally connecting. It's properly immersive, an overused term, and it's exciting. So they see the ability to leapfrog. The studios, we're having some early stage conversations. They're all kind of same thing, like, come back and prove it. Once you have a couple, then you're going to be big enough for us to buy. And then we just got some musicians and some actors that are like, this is cool. This is just a really interesting. And that's where we're at right now. So that's our update so far.
Okay, we've got
Thank you.
a few minutes. Stay there. We've got a few minutes for questions before we go for coffee. That'll be half an hour. The speakers will all be there, so you can continue asking questions. But let's just have a couple of questions now. Would you like to start?
Great presentation.
Thank you.
Can you talk us through how AR Brendan, can you talk us through how AR might feature into your project, please?
I have a video that we should have put in here that is a bit jaw-dropping. There's a gentleman named Ben Dawson. He started a company called Immersives. He is focused on music, and he's focused on music talent, but also genres. He's got a video called Acid House, and he's kind of placed it within the Berlin venue, and if you think about all these boxes, we got 5 boxes in that. It takes you from Detroit to Chicago to London to Ibiza to Berlin, of course. And it's just unbelievable. And the whole exhibition is AR. So you've got all the kind of, you got the props and everything like that, but it just layers on this other world. And then you can do kind of everything. The technologies, as somebody who kind of grew up in Silicon Valley and seeing tech and everything like that, and it was all just in an online channel on your computer and everything, we're seeing tech now hit the real world, and it's going to create some unbelievable experiences. We saw the founder of a guy named Franco Dragone, the best name in the history of the world, but who started Cirque du Soleil. He came up with a food hall concept, and it was just otherworldly. So yeah, AR, VR is an augmented aspect to real world experiences. We're selling escapism here, and that's going to help it.
In order to stick to time, I think I'd like to break for the coffee. By all means, talk to the speakers out there with the coffee. Do come back at 11:15. Can I just finish with one question? I mean, the way you presented, it seems like a no-brainer that somebody should be investing in this. So I've been fascinated that it hasn't happened. Is it the sort of thing where if you get one anchor person like Tom Hanks who puts in 5 million or a few million or whatever it might be, that suddenly everyone else will go, well, it's got to be okay then? Is it kind of a bit like we were talking about with Martin, but that's with consumers? If you just get one investor, the dam's going to break, or...
I don't know if I'm allowed to say this. We're waiting to hear back whether one of the members of U2 invests, and even if he puts in £1, we'll raise the rest of the 7.8 million. But absolutely, I mean, they need an anchor because that de-risks it as well. We may have that anchor. We'll see. We're waiting to hear back in the next week on that as well, but that certainly helps de-risk it. Yeah.
Thanks.
Thank you.
Anyway, I hope you found that interesting. Thank you very much to the speakers. After the break, it won't be war stories, but it will be possibly discussing how there is a solution to all of this. It'll be very interesting to hear about what sources of finance, what's changing, and I hope you all join us at 15:15. Thank you.
Hope you all enjoyed your coffee break and got a chance to speak to the great speakers we just had this morning. I'm going to be talking about the Global Intangible Finance Tracker. I've been working on this for the last couple of years while I've been working at Brand Finance, and it's a tool that David started back in 2001, and we've actually since backdated it to when Brand Finance was founded, all to measure globally what are intangible assets worth. And intangible assets are one of the ways that you could measure how innovative a company is. It's all about the intangible capital that those companies are creating. And globally, we found last year that intangible assets grew by 8% to $62 trillion worldwide, which is about 2 times the size of the US economy. So it's no small figure. I think one thing about the Global Intangible Finance Tracker that we found over time is that it's really curious, and curiosity has been killing the cat a little bit in terms of why are intangible assets still not on most balance sheets, and why are they not understood by most organizations today. Because we always have argued that intangible assets could be key for high growth companies and high potential companies to secure additional funding, both through equity and debt markets. And that's something that we're really excited to hear a little bit more about this afternoon. But firstly, I'll just provide an overview to what intangible assets look like in the UK. Now, intangible assets, as a quick recap for anybody not familiar, are the additional assets on top of your property, your plant, and your equipment. So the blue assets, as David was saying earlier, which are the tangible assets which you can touch and feel they have a physical substance. That includes plant and equipment, so any physical machinery that you have, the land and buildings where you have your operations, and working capital as well, so your inventory and all of that. So intangible assets are everything else on top of that. And personally, I think they're the exciting assets for businesses. So it's the artistic assets that you might have, your brand assets, obviously core to what we often talk about here at Brand Finance, but also customer assets, contract assets, and technology assets. And I think when people talk about intangible assets and innovation, a lot of what they think about nowadays is patents, software, and technology, and that is driving a lot of value. But the two categories that I think are the most tangible of intangible assets are technology and marketing or brand-related intangibles. But the way we think about this is the total value of a business is comprised of the value of all of these different things. And when we look at the total value of UK businesses over time, we can see how much of that is driven by tangible assets. Still quite a large share of UK businesses. This is based on 937 listed UK firms. Still quite a large proportion of their value is tangible, and the rest of it is either disclosed intangibles, so that dark blue is disclosed intangible assets like brands, patents, customer lists that have been gained on acquisition. And the green section is disclosed goodwill. And one thing that we've always found curious when looking at the Global Intangible Finance Tracker is how much value is put in as goodwill into balance sheets. Goodwill is basically a technical balancing figure that's used by accountants to make sums add up. And one of the things that we've always found strange is that goodwill typically doesn't get written down in balance sheets and is mistrusted by users of financial statements as a result. And goodwill has been the burning platform in the last couple of years for why there's the need to fundamentally rewrite the way that intangible assets are measured and accounted for. And we're really excited to see that there is a lot of progress in that space. In fact, the International Accounting Standards Board meeting right now to talk about the intangible asset agenda. But I digress, because the remainder of the value that we see in businesses, we say is undisclosed intangibles. And the whole point is that they cannot be disclosed, they are not measured, and therefore we kind of rely on the way that investors value these businesses to estimate how much they could be worth. So investors are not oblivious to the value of these intangibles, because if they were, that light blue bar would not exist at all. But we feel that there is a lot more scope for investors to get better information about the value of those intangibles, not just for information's sake, but to help them in allocating resources and to help those highly intangible companies to get the funding that they need to grow. In terms of industries in the UK, you might not be surprised to hear that pharmaceuticals is the most intangible industry in the UK in terms of the value, total value of intangibles for those businesses. That's slightly declined from last year, but still very much the dominant industry in the UK, followed by chemicals, cosmetics and personal care, largely due to Unilever. Tobacco, still a very important industry for the UK, but interesting, a lot of the particularly brand intangible assets that tobacco companies now achieve is outside of the UK because of the plain packaging that we have here in the UK. So, and a topic of discussion for the Prime Minister is how do we regulate this industry and make it safer. So that's probably something that we might see become of less importance in future years. But the big industry that's missing from this picture that we see in all other major markets is technology. And the technology sector is really, we feel, underrepresented in the UK in terms of the growth opportunities that are offered to it. We're now going to be talking, and we have a couple of speakers that are going to be talking about something called intellectual property. And sometimes people use intangible assets and intellectual property interchangeably. But the way to think about intellectual property is it's a subgroup of intangible assets. And it's a subgroup that can be legally protected. So within intangible assets, you have intellectual capital, which is your contracts and relationships and different dynamics that you have with other stakeholders in your market. There's also intellectual assets, so that's your human capital, your know-how, any information that you might have that gives you a competitive advantage. But the subset within that is which we find to be like the most monetizable aspect of intangible assets is intellectual property. So that's things that are legally protected, like your trademarks, patents, copyrights, designs. The map icon is for geographical indication, so like Champagne, for example, and databases. And what we have found is that intangible-rich and IP-rich companies perform really well on equity markets. And this graph is actually showing backtesting that was done by Legal & General Investment Management ahead of the launch of a product they introduced last October, using data from our top most valuable brands in the world. And they've created a global brands ETF, which has outperformed the S&P 500 in backtesting and so far, I believe, as well, since its launch in October. In terms of bank loans, from our GIFT study, we've estimated that there could be between 400 and 700 billion pounds of additional debt funding available just to those 937 listed companies that we looked at. Extra funding available to them if they were able to take a loan secured on their IP. The current value of the debt of those companies is just over a trillion pounds. So that represents between 40 and 70% growth in funding available to these firms in the UK. So a significant amount of extra funding available. But this is not going to be easy. And we've had clients approach us in the past asking us to value their brands because they'd like to take it to a potential lender and see if they can get a loan on the back of it. But it's an uphill struggle for them at the moment because banks are not as confident in it as a model because it's not, there's not as much of a track record as there is on securing loans on the value of a property or of other physical assets. So this is something that we are seeing progress in, and really excited to hear from Neil about this, about the loans that the new loan product that he's developed at NatWest. And we're excited to see how that can grow and how that can provide funding to highly intangible, innovative companies trying to secure funding to grow further. So with that, I'm not doing an audience Q&A, sorry. With that, I'm going to hand over to Ben Llewellyn-Jones, who's the Director of International Policy and Business at the Intellectual Property Office, to tell us a bit more about what the UK is doing on this. And following that, we'll have Neil Bellamy from NatWest talking about the product he's launched at NatWest.
Brilliant. Thank you very much indeed. My name is Ben Llewellyn-Jones, and I'm the Business and International Policy Director at the UK's Intellectual Property Office. I'd like to start by thanking Annie and David at Brand Finance for inviting me here today, us here today, because my colleague Finn is in the audience too, to speak about the work of the UK Intellectual Property Office and the UK's current IP-backed finance landscape. And I'm very privileged to be preceding Neil. Neil's far more interesting than me, so I'm going to give him lots of time to speak, don't worry. But really interested to see and hear more about progress on the product that he will discuss. Firstly, just a little bit about the UK Intellectual Property Office. As Annie alluded to, IP can sometimes be a bit scary or a little bit further away from people's immediate impression of what's important. So who are we? What do we do? We're the government body responsible for the UK's IP system. Our role includes granting IP rights, such as patents and trademarks, as well as ensuring the IP framework keeps pace with change, both domestically but also internationally. The IP system and the role of an IP office has changed significantly over time. And at the end of May, it will be 400 years since the first statutory acknowledgement of patents in English law. And next year, we'll also see the 150th anniversary of the Trademark Registration Act, which act allowed formal registration of trademarks before the Intellectual Property Office. And there's a common misconception that IP offices are solely property registries. Our rights granting services are a key part of our role. It's why we're transforming how we deliver our services to ensure they are accessible, easy to use, and meet future need. Alongside this, though, we also have an active policy function, engaging at international fora, engaging at sessions like this, helping join up enforcement agencies, and really trying to ensure that IP promotes innovation and creativity. That's a big part of what we're trying to do. So a key part of this is focused on how we can better support businesses to effectively identify, protect, and indeed manage that IP. We want businesses to see their IP as an asset, helping them make the right decisions at the right time for their business, whatever those decisions may be. Even as our policy and operational remit has evolved, our central mission has remained unchanged, which is to promote innovation in the economy. That's correct, yeah, thanks. So innovation sits at the heart of the UK government's agenda, and increasing investment into new innovations is key to helping address the major societal and global challenges that we face today, from climate change to ageing populations to tackling degenerative diseases. And we know that countries which invest in innovation grow faster than others. Investment into intangible assets enables long-term improvements in productivity and indeed economic growth. And in the UK, we have a long history of contributing to global innovation, from the steam engine to the World Wide Web. And we consistently rank among the top 5 most innovative countries in the Global Innovation Index. We have the largest tech sector in Europe, reaching a combined market value of £1 trillion in 2022. But we know more is needed to help encourage further and faster innovation and investment into the industries of the future. So the UK's Science and Technology Framework, a cross-government strategic vision for science and technology, sets an ambition to create a start-up and scale-up finance ecosystem capable of nurturing the next generation of globally competitive science and tech firms. And we recognise the importance of learning from the experience of others, including partners abroad. So as policy makers, an important framework for this discussion is the importance of intangible assets. Over the last half-century, we've seen a shift in the main drivers of business value, away from tangible assets towards intangible assets. And today, business performance and value relies heavily on technology, brand recognition, and creativity. It's these assets that drive modern enterprise success and account for the overwhelming majority of a firm's typical value. I'm just going to flip back, I think. There we go. Since at least the mid-2000s, estimates show that investment into intangibles has predominantly been higher than tangible assets and less volatile in the face of economic shocks. A record £135 billion was invested into intangible assets, excluding training, we say, in 2020 in the UK, according at least to the latest available estimates from the ONS. And I'm hoping, yes, indeed, on the right-hand side of this slide, you can see a breakdown of investment by asset type in the UK. Now, just this morning, hot off the press, the ONS published its latest figures on investment into intangibles for 2021, and I can confirm that overall investment into intangible assets rose by its fastest rate since 2017. And in 2021, we saw a record £150 billion UK pounds invested into intangibles. Notably, the asset type which saw the largest annual increase in investment in 2021 was branding, where expenditure rose 10.6% to a record £28.1 billion UK pounds. So let's look at the role of IP and its role in an intangible-driven world. We know from research that over half of intangible assets are protected by some form of IP. And the IP system plays an important role in helping promote intangible asset-driven growth. And IP rights offer inventors and creators the tools to commercialise a wide range of human ingenuity, from new inventions to distinctive brands to original designs and indeed creative works. And today, IP plays a key role in how businesses compete and grow at home and abroad. And in the UK, IP-intensive industries account for a quarter of non-financial output, around £300 billion a year. These industries represent 16% of UK employment and more than half of the export value of UK goods. And this brings me on to IP-backed finance. So firstly, what do we mean by IP-backed finance? In short, it's about using IP assets to obtain funding, whether that's attracting equity investment or helping to secure a bank loan. And we know that for any business, we know that accessing the right finance at the right time is critical throughout the business life cycle. And financing consistently ranks among the top issues on the mind of leaders and innovators, alongside talent and skills, as well as, of course, market access. We also know that financing innovation, especially for the industries of the future, like artificial intelligence, bioengineering, and semiconductors, can be extremely capital intensive. So IP-backed finance is about reorientating our focus to the assets that innovative firms not only have, but drive their performance and value. And it's about seeing IP as a financial as well as a competitive asset. There are several challenges to mainstreaming this practice. Regulatory and non-regulatory obstacles, such as awareness, can affect the use of IP as a financial asset. For example, the treatment of IP under accounting standards means IP value is often hidden in financial statements, and this can limit information available to investors and lenders. It's also important to recognise that the challenges are different for equity and for debt finance. In practice, we know that equity investors will often care about IP. Indeed, a recent study by the European Patent Office and the European Union Intellectual Property Office found that startups with patents and trademarks are up to 10 times more likely to successfully secure funding from investors in their seed and early growth stage. Of course, IP isn't the factor. It's just one consideration among others, such as team quality and market opportunity, that will factor in investment decisions. Of course, the level of IP awareness and quality of due diligence can vary across investors and sectors too. And we know that technology firms often receive the largest amount of equity investment in the UK. Reports indicate a significant amount goes into IP-intensive sectors such as software and indeed life sciences. But as a firm grows, equity investment may no longer be a viable option. For example, the sale of shares may be too expensive, or business owners will not want to reduce their equity stake. This leads me to the role of IP in lending. We know banks are a key source of finance for small and medium businesses. This is true for startups and high-growth firms. And in contrast to its importance in equity finance, IP is not considered in most mainstream lending decisions. Lenders prefer tangible assets such as housing or equipment as loan collateral. It's not surprising, given investors lean into risk, whereas lenders have a lower tolerance. But the result is that IP-intensive firms whose value is mostly intangible can find it hard to secure loans, or at least on the right terms. And this limits the options available to them. Yet despite this position, there appears to be market opportunities for banks to lean into and to lend more to innovative firms. So in 2018, the Intellectual Property Office, we worked with the British Business Bank to conduct research into the Enterprise Finance Guarantee Scheme, which was then the government's then titled Loan Guarantee Scheme for SME lending. And the findings were remarkable. We found that firms with registered intellectual property rights, patents, designs and trademarks are associated with lower rates of default, and where they do default, lower rates of loss to the lender. And as such, IP-intensive firms may make better lending candidates. So before I move on, it's worth noting that there can be a common misconception that IP lending is just patent-centric, and that's not true. Evidence from the US and France indicate that the majority of IP lending is against trademarks, including the importance of this IP right to helping firms grow. So where does this leave us today? We recently published a report on the UK's IP-backed finance landscape. It was a collaboration with the UN World IP Organisation, WIPO. And while the report acknowledged the challenges I've set out, it also reinforced a clear message that the UK has real strengths here. We have a strong IP regime, a healthy pool of innovative firms, and a vibrant financial sector. And it's encouraging to see real progress in this space, with some banks starting to look seriously at IP-backed lending. And in the last 2 years, we've had 2 major banks launch new IP-backed loan products, HSBC UK and NatWest. And I know Neil's going to cover NatWest's new IP loan proposition for high-growth firms shortly. Elsewhere, it is positive to see increased international impetus around the visibility of IP in business reporting. And the International Accounting Standards Board, which I think Annie alluded to earlier, has added intangibles to its research agenda. And here at home, the UK Endorsement Board, responsible for adopting international accounting rules in the UK, has actively been conducting research into investor needs around intangibles and financial statements. So change is unlikely to occur very, very rapidly, but these are the first steps towards informing regulatory change. And even in the absence of any immediate regulatory change, the conversation around the recognition of intangibles in financial statements has begun, both at home and abroad. And this might prompt a look at non-regulatory alternatives. So, what are we doing at the UK Intellectual Property Office to support this momentum? So we believe our role is to inform, to convene and to enable, and our forward work is determined very much by this understanding. So in March, we set out several steps to help improve market insight. So firstly, we committed to establishing an industry advisory group to bring together stakeholders from across the financial sector, industry and academia. And this will be an avenue to test policy thinking and help shape the IPO's future work. Secondly, we will develop an annual report to help offer regular and consistent insights on IP-backed financing. We believe these steps will help support industry-led momentum around leveraging the value of intangible assets. And thirdly, we'll look into our own process on how security interests are registered at the IPO. And our hope with all this work is that we'll offer the data and indeed the insights to inform industry-led change. And a focus on IP in a financial context offers opportunities for firms, investors, lenders, and others. So this is a journey, and we recognise that engagement with stakeholders such as yourselves will be vital to help realise these benefits. So if there's one thing that you take away from this, it would be, please do engage us. We can do this better with your insight, with your views, and we can inform policy better and help ministers to make better decisions as a consequence. So I'd like to thank you all for being here. I hope these insights are useful, and I look forward to joining for Q&A, which you might want to do now or after Neil. I don't mind, Annie. Sure.
Annie showed that the potential lending was between 400 and 700 billion. Have you guys done any kind of estimate of what you think the scale of potential lending might be to UK industry? And have you calculated at all what impact you think it might have on the UK economy if it were to happen?
So I don't think, and I'd be reluctant to share figures of that kind. I'm conscious of being recorded as well, which is great, but that would feel like a kind of pronouncement into the ether. I don't think we have. I would be very interested in our advisory group looking at some of those issues. I mean, calculation is always the key, and how we do that in a meaningful and measured way. But what I would say is that over the next 3 years, this is year one, what we'd really like to do is to increase visibility of questions like that, to be honest. In some ways in this room, I think there are some people for whom this is unfamiliar, but many people will be already relatively familiar with some of these concepts. We'd like to reach beyond that with a sense of the scale of the opportunity, which I think is what you're alluding to, and to some extent be able to show that.
The thing that really strikes me about it is that in an election year where Rachel Reeves and Jeremy Hunt are both quite important in the outcome, neither of them is talking about this subject, and yet they flaff around trying to think of ways of getting growth. No one has mentioned this subject, and yet it's a big one. Yeah.
So as a very impartial, non-political civil servant, just to frame the question in that way, I would say that all ministers and potential ministers no doubt are thinking about the opportunities for growth. And I think certainly with the current government, the potential is both real but not necessarily as well understood as it might be. So I think there's still an opportunity within government, and certainly with any future government, whoever it may be, to explore this. And then I think look at some of the choices that could be made, for example, around accounting standards or other things that could make it still more possible. But yes, interesting opportunities for those to explore. Annie.
Okay. Ben, it'd be great if you could just tell us a bit about other countries and other intellectual property offices and whether IP commercialisation is on the same level of agenda for them, or is the UK leading on this, or are we lagging?
We're certainly not lagging. We'd like to think we're leading, but we're amongst decent partners. So South Korea, there's a government have had a government-backed loan guarantee scheme for IP-rich startups. I think in 2020 facilitated around 7,000 loans by IP assets. Singapore, perhaps unsurprisingly, IP financing is a key part of their IP strategy 2030, and they launched a voluntary framework for IP disclosure and business reporting. India, Saudi Arabia are thinking about this, developing action plans. I think Italy too. And in the US, on the other end of the spectrum, there's a lot of market activity, but less policy focus on IP financing. So, and I think the process of the World Intellectual Property Organization launching these reports, not just on the UK, but in partnership with others, is part of that willingness to try and kind of drive interest and competition. But yeah, it's not as cohesive, nor indeed as visible as it should be.
I think we have some time for some more questions here.
Just one quick question. You had a chart on the pie chart on the investments of the various different asset classes. Yeah. Brand, David was talking about the fact that you can't reliably value it. So how is that acquisitions of brands? what feeds into that exactly? How's that investment counted?
Yeah. I'd have to check if I'm honest with you. I'd have to check precisely, but I won't pretend to precisely be able to dissect it. I mean, are you driving at the question of valuation itself? Or?
Well, yeah. I mean, it's just a thing that we often come across is that brand can only be put on the balance sheet when it's acquired.
Yeah.
Even though people are obviously investing in it, but it then gets deemed to be not reliably valued until it's been acquired.
Yeah.
And so I was just curious as to how that number popped up there, whether it was sort of spending money on marketing or whatever it was. And then the other thing that came to mind was the IP box that the Italian agency Entrada did, which I'm not sure was hugely successful. But that included all IP, not just R&D spend, because the UK has a R&D spend tax break as well. And so it just sort of made me wonder how it's all calculated and all that sort of stuff, because obviously that's what brand finance does.
Yeah. Well, let me take that away and reflect on it and come back to you, to be honest, but it's a reasonable question. And yeah, I think I understand the Italian scheme was not, I'm going to flip to the end so that the next slides are not out of sequence, but I think the Italian scheme was not quite as successful. I mean, I think the truth is, coming back to Annie's question, a number of countries have tried in different ways, not just to raise visibility, but to prompt engagement, to kind of develop secondary markets, to do what they can. I mean, we're an IPO, we're an office. We don't lend. We certainly don't build secondary markets. We don't build valuation models. I guess to the extent we can, though, what we'd like to do is encourage common approaches to this that mean these kind of questions you can have kind of reasonably common answers to. And I think that would be part of the aspiration of the working group that we're setting up, but also the kind of international engagement we're doing. Shall I pause there? Oh, there's one more. Okay.
Hi. I just have a question about this IP finance and whether I can see a conundrum. I'm wondering whether it'll actually work, because presumably in order for a bank to lend, it will require a strong valuation of that IP, which will come from revenues, profits, and other measures. But if the business has already got that strong revenue and profit to justify the valuation, possibly it doesn't need to borrow the money. Whereas if it does need to borrow the money, it's because it hasn't got there yet, and then they won't lend it to them.
So I'm going to neatly throw that question over to Neil when he comes up.
Okay.
Because I feel he would give you a significantly better answer as to why people are borrowing.
Later.
Okay. I mean, the fact is people, Neil will speak to his own product, but people are borrowing. So the question, I guess, is the degree of success, or why and who. But yeah, I mean, we don't see the absence of possibility there, but I understand the question, yeah. I've got two questions though, apologies. Were there others? Okay, maybe I'll pause. I'm very happy to take questions. Oh, there's one more. Oh, so sorry, thanks.
Hi, yeah. I work with a lot of kind of high growth tech businesses and things like that, and I'm seeing a lot of people quite naive to the value of their IP and patenting and so on, and actually engaging with larger businesses that later on will decide that they quite like the look of their product, trademark it, put all the patents in, and then do it for themselves, which obviously from a legal standpoint can happen. Someone's not protected their IP and so on. But I wonder if the office is doing more around education or putting rules in place, which is if someone has clearly bought in a product or whatever it might be, and it's been very obviously ripped off, whether a startup or a fast-growing business has protection over that.
So we do a lot on education, trying to address that kind of question, that kind of issue, but to be honest, more broadly. So we have an education program which, at the very basic level, tries to influence the curriculum of primary school students. What teachers know, at least, about IP at that point. I think more relevantly, it kicks in really around the higher education and the points at which, for example, startups and spin-outs are starting to look at their own IP. And again, working with universities and working with incubators, we've been trying to show the possibilities, show the kind of framework, show the kind of contracts. It is difficult, to be honest. It is difficult. I think one of the most successful avenues for education has been through patent attorneys, trademark attorneys, because of course they care deeply that people do protect their IP and do register it. I mean, ultimately, it is a legal right. If you don't protect it, then you're subject to challenge, and that is a difficulty. And I think it's through education we can address that. Often I think we find that the most zealous advocates of IP are the ones who've been burnt. And that's not necessarily a good thing, but it's true. And certainly in terms of our support to and through regional authorities where we work with businesses, you find people who can talk to the difficulties of their experience, who can then advocate. We have our own IP audits scheme as well, which is launching again in June, which is, it's not massive in scale, but it does help businesses to audit their IP and understand what IP they have. And then, to be honest, make sensible choices. And the truth is, finance is a challenge. Some people say, well, it's great to know what I've got, but that's all I can do right now. And they don't then go on to protect, or they don't go on to do more. You know, we'd like to look at why that is. We'd like to encourage more people to take out protection so they don't encounter the same kind of challenge that you've alluded to. But, you know, we're also cognizant that finance is always going to be a factor. And IP, as I said earlier, is one of the things. It's not necessarily the thing that people have to consider when they're starting up. So yeah, I mean, it is an issue, it's a challenge, it always will be, but the more we can do to help people to understand the possibilities and make well-informed decisions, the better. And also understand the licensing opportunities, to be honest, which is generally where they trip up.
Thank you.
No worries.
Great.
Okay, thank you.
Hello everyone, my name's Neil Bellamy. I'm head of Tech Media Telecom for NatWest Bank, and thank you, David, and Brand Finance, and for the invite today. Very delighted to be here. And Annie reminded me actually of your story. I'm just going to divert for a second. I've been a banker for 30 years, frontline banker, and your story about the treatment of goodwill in accounts kind of reminded me. It took me all the way back to my branch banking days, and I was a terrible cashier when they used to put graduates through every job in the branch back in the good old days. And I was a terrible cashier. And I used to have a little pot underneath my cash counter, slush fund, that when I couldn't balance my till by the odd £2 or £3, rather than scrabbling around trying to find the balancing item, I'd borrow £2 out of my own money, by the way. It wasn't the bank's money, just to balance my till so I could go home. And I probably reflected on that and thought, I probably should have put that in my goodwill pot rather than my slush fund, because that's really what goodwill is, isn't it? It's a balance note. Anyway, just to prove I've been doing banking for a little while. So yeah, I run the bank's tech media telecom sector. We do lend a lot of money to IP-rich businesses. I lend 14 billion in the UK economy. So the problem really isn't lending to IP-rich businesses that I'm talking about today. It's the SME market. And I'll go into a bit more detail in the gentleman's question. I'll get to that perhaps at the end. But it's a distinct problem, and most of you know 95% of the UK businesses are SMEs. They're not the big listed companies that I'm lending to, or even medium size, when they're making 50 million EBITDA, they've got no balance sheet, but I can lend to them, no problem, cash flow lending. But the vast majority of businesses in the UK aren't like that. So I'm an IP evangelist, have been for a long time as a banker, mainly because of that vested interest, because none of my businesses, tech media telecom businesses, have really much assets in their balance sheet. So unless I come up with a solution to this problem, I'm out of a job in a few years' time. So pure vested interest from me. I work with a lot of high growth IP-rich businesses as well outside of the bank. I'm a mentor for Imperial College. So as well as seeing loads of software and media names and people rich in brands, I also deal with a lot of deep tech, med tech firms that are spinning out of Imperial as well. So I've really seen that end of the market. So come at this problem with lots of different angles, really. So what I'm talking about today is really trying to unlock what Annie was talking about there, unlocking the potential, and what Ben was talking about, of the UK economy. Because all the best companies in the world, actually, as well as in this country, aren't buying property, aren't buying fixed assets, they aren't investing in that. They are working off ideas, innovations, brands. And if as banks, if we can't unlock that problem, or as a country, we're only going to go backwards. So I'm going to talk about what we've developed at NatWest, which is an SME product, which I think is a world first. Show you some customer stories, because it gets really interesting when you talk about customers, and walk you through it and take some questions at the end, really. I need to probably change this slide because we're well into the new year now. But in January, when I started talking about this, it was a new year, new economy, new loan. And the first thing to say is this is not just a tech problem. So I run the tech sector, but we are talking to businesses from all across the economy. So climate tech, mobility tech, manufacturing, of course, fintech, which as a country we are fantastic at. We've done lots of fintech stuff as well as some ag tech businesses I'm talking to at the moment. So it's all across the economy. And the productivity of these businesses is 10x of their competitors. And what's the problem? So I observe all the time IP-rich innovators getting to a certain stage in their development, perhaps getting to break even and starting to scale up, high growth businesses, IP-rich, and getting stuck. And they're trapped in this sort of broken funding system. I really believe in this country we've got great universities, we don't have an innovation problem. I know mention of VCs earlier on and investors and private equity. We don't really have an equity problem from my experience, and I'll share some numbers later on. What we do have is kind of a debt problem really to help these businesses to scale. And I came across a business and how I set up my proposition and inspired me to try and come up with this loan. Had a small little business called DeepMind that walked into Cambridge branch of NatWest 10 years ago. A guy called Demis Hassabis opened his bank account. We looked after them for 7 years in NatWest. We looked after their money well, gave them good service, did the odd business card for them, paid their salaries. Didn't really have anything in our kit bag to prove our relevance to DeepMind as a business. Demis went off and raised some money from Y Combinator and Silicon Valley, and sold the majority of his business to Google for 400 million pre-revenue. Now look at that innovation. I know they're still, the AI that's driving Google at the moment, British talent. Look at that value creation. Look at all that innovation. And as a bank, I'm sat there thinking, I'm not really relevant to those guys, so no wonder they moved to Bank of America, not NatWest. So that really inspired me. Right, we need to be relevant to these businesses earlier in their life cycle. I'm not talking about providing equity. We don't do that as a bank. We provide debt. So you've got to have a product that works, and you've got to have customers that are willing to pay for it. Then it means it's debt. But when you're into that stage, I think we have a role now with this new proposition to help businesses scale. So let's get in some nitty gritty detail. Is Martin here today? Here you are. I can talk about. Be careful what I say now, then, Martin. So we've teamed up with Ingot. I've been working with Martin for about 10 years now. So Ingot are our valuation partners. So we'll get into the nitty gritty of IP valuation later on. But don't get me wrong. People have been lending against intellectual property, perhaps when people get to scale, for quite a long time. What I wanted to do with Martin and Ingot was come up with a scalable SME proposition. So it's a new partnership we've got. We work together on deals. We've got our first one away, our first 4 or 5 approved, another 14, 15 in progress at the moment. So this is happening at the moment. And these are the kind of headlines. So I'm not reinventing the wheel here. We are still doing normal lending, but I have just applied tangible asset methodology to intangible assets. So we're lending against assets that high growth firms are monetising to repay our debt. Pretty simple, that. But what's really critical is, over the years, my clients that have built on intangible assets, their interests have started to misalign with us as banks. They may have a property they're operating from, usually leasehold, sometimes freehold, but those assets have nothing to do with the success of their business. In fact, quite often they're a liability, as we saw in the COVID era. Those tangible assets are a liability, not an asset. So I'm lending against assets that are generating revenue that pays our loan. So for the first time in a long time, banks and IP-rich businesses, our interests are aligned, and that makes for good lending decisions and good decisions from the owners of those businesses. We don't do anything different. We don't take ownership of the IP. I don't want to own IP. We take a good old-fashioned fixed and floating charge. So again, I've been lending long enough, so if I was lending to a printer, back in the day, they were a very innovative business, weren't they? Print presses. I would lend against that print press because they were printing stuff that they are selling to generate a revenue to repay my loan and get off against that printing press. I would take a fixed charge over that printing press, that Heidelberg 5-colour print press. In fact, in my early days of banking, we even went out and hammered a little plaque on it to say that's ours, if in administration. That's kind of what I'm doing with intangible assets. We'll register our interest at the IPO office or company's house. It's good old-fashioned lending, fixed and floating charge. Martin and the team will value the intellectual assets, actually. I wouldn't say it's just purely IP because it's broader than that. And I'm lending up to 50% against that value. So I think it's smarter lending because Ben's point earlier on, and that piece of research actually, Ben, was absolutely critical to getting this away. High-risk, IP-rich businesses are lower risk. We've got statistics that absolutely prove it to my credit team. I had to tell them 10 times, though, before they believed me, but they would. So you guys should be rewarded with better terms because you are lower risk. I hate taking personal guarantees. This removes that from the equation, which is very popular, as you can imagine, within the SME world. And it provides me with a differentiated product when we're talking to high-growth businesses. We've always been out there supporting them with accelerators and connecting them to other bits of the economy and our client base. But we've now got something in our kit bag that we can pull out and say, I can hopefully be your first lender on this high-growth journey. So this is the game changer. These loans start at 250,000. So all you've got to prove to me is your IP is worth 500,000. If you're a software company and you're paying developers, God knows how much you're paying developers nowadays, it's not much value. You can have 2-3-man businesses that have got IP valued at 500,000. So this is a really mainstream product. We're going up to 10 million, but let's see where we get to. But it's from 250 to 10 million. We'll make sure that we can't lend to you traditionally, first of all. So if you do have assets, of course, we'll lend against them first because it's probably a little bit cheaper. Invoices, stuff like that. But if not, we'll pull this out of the kit bag. The main issue here that we've learned, and it's kind of obvious, but not to bankers because we're a bit dull, is that we can't lend and forget. We do actually like lending and forget. It's why we like property and fixed tangible assets, because we can lend and then forget about it because we know we can come and get it and that will pay us off. But IP assets are dynamic. We need to stay in touch with them. So Martin and the team at Ingot also help us by continually monitoring the IP on a quarterly basis, but also providing an annual revaluation, which hopefully shows value's gone up, clients can redraw, and up we go. And the real customer benefit is, if you pledge your IP as security to me, just as a printer would do, you get your first year interest only, so you should be able to get a higher debt quantum because it's interest only. You keep more of your cash to accelerate your growth. And as I say, we revalue on an annual basis, and if it's all's gone as planned, you've taken my money, invested in your business, your IP should have gone up in value, we can redraw it up in there. So we do 4 years in total. We've also agreed a lower debt quantum that you have to reach. So usually 1.75 times we're looking for in terms of debt servicing cover to cost of the debt of the loan. We've reduced that to 1.25 for the first 2 years. So interest only, lower debt ratio that you have to meet, because we're hoping businesses are doing that. Some of the customers we're talking to at the moment, just to give you an idea. So Charco Neurotech, please check them out on LinkedIn. They're brilliant on LinkedIn. Lucy was a founder I've been helping from Imperial. It's an Imperial spin-out. It's a non-invasive wearable device for people with Parkinson's, helping to bring back smiles for them. There's some great videos. There's one in this presentation, but I've got a better one later on. So they're a high NatWest customer. They're high growth. They've raised about 10 million in equity. as a medical device company. They're IP rich, lots of patents, but they've also got software, copyright, data. They're generating revenue from their wait. They've got 20,000 Parkinson's sufferers on a waiting list for this device. They need funding from someone to scale up their production. It works perfectly. So we're talking to them at the moment. There's a great video of Helen with or without her device. Please go and check it out on LinkedIn. It's fantastic. She's a real show-off. This one I wanted to show the video on because it's got the branding angle, basically. Open Bionics, advanced lightweight 3D printed bionic arms. They're 3D printed. Again, NatWest customer down in Bristol, looking to turn disabilities into superpowers, particularly popular with kids. They've got a license agreement with Marvel and Disney. So they're really flipping the disability of the prosthetic arm into, look, I'm Iron Man, basically. So if you could run the video, we've got a great video just to bring this.
All right.
This is Alex.
High five. Can you hold my fingers? If I put my fingers in. Wow. One sec. He's off again.
I never ever thought we'd ever see this day, to be fair. Ever.
I can be able to lift weights.
Yeah.
There you go. So that's why I really are doing what I'm doing and been banging on about this for so long. So yeah, and Alex did generally never wore a prosthetic arm because he saw it as a disability, and then they said you could have a bionic arm like that, and he was like, yeah, I'll have that. So that's great. So we're talking to Open Bionics at the moment. They've achieved sales in the UK, looking to take this to the States in about 6 different clinics over there. So look out for that. So how have we done what we've done? So working with Martin, they've very kindly built a platform where our clients go so all of the valuation is completed on this platform. The benefit actually we didn't even think about, it shortened the time it takes us to do loans because of course Martin's not going out to look at anything tangible. It can all be done on the portal online. It's brilliant. And this is how it works. So we put in a stage at the start where our clients not sure what their IP is worth, if it's going to be good for us as collateral. Equally, I must hold my hand up as bankers. We're getting used to these assets as well. So my frontline RMs are not that familiar. So what we've done is a first profiling stage, free of charge. Our clients use a discount code, go onto the Ingot site and get a profile of their intellectual property, just to say, yes, we think NatWest could lend against that, or not quite yet. You need to do a bit more. Usually it's on revenue generation, to be honest. But come back once you've got that green light to my managers and get an agreement with in principle, yep, we can lend you that money. Step 3 is then back for the traditional valuation with Ingot. And you'll notice the price is £890 plus VAT. That's a real change for SME businesses, a real low barrier for them. In fact, some of them are going, actually, I'm just going to have the valuation straight off the bat for 880 quid. But we've put in that stage. We then get full approval and do all the loan documentation. So as I say, we've done one software. We've got 4 other approvals. We've got another sort of 20 on the go at the moment from across the economy. We've got quite a lot of other businesses that are talking to us. Yeah, I thought I'd finish there and take some questions.
Thank you. That was very interesting. The thing that you showed in that case history with the kind of little lad and his arm, there's 2 kind of very powerful things in the background there somewhere, isn't there? That this is an exceptionally good thing to do from a kind of cause point of view, and you've got Marvel. How much in your decision making do those things play a role? Because actually it's back to the old bank manager. Would you lend to these people? Well, hey, guess what? They're backed by a massive multinational American kind of corporation because they must have some kind of interest in it, or at least they're granting their IP for free.
No, they're licensing it from Marble, yeah.
Whichever.
Yeah.
So all I'm saying is that at least you've got that, and then you've also got this notion that just says, doesn't this make us feel that we've done the right thing? Which you have, by the way. So I think it's very laudable. But someone with a kind of fintech business that's written some classy software, it's not as attractive, is it really?
For a bank, yeah, actually, I love fintechs. I've lent tens of millions to fintechs, absolutely. Software companies aren't as interested in a PowerPoint, are they? Come on. But yeah, no, software is going to be a core is a core one for us, and we've done lots in fintech, and we'll do lots more. We're doing loans. So what Martin and the team at Ingot are helping us identify is the relationship between the intellectual assets of the business and the relationship with revenue and profits. As a hard-nosed banker, I'm not interested in stuff that you've just spent 10 million quid on. That's research and development. That's not. But what I am interested in is, what revenue, what profitability is those intellectual assets driving, and they could. That's why I say we could do registered IP or non-registered. It could be databases, it could be contracts. Usually, it's all wrapped into one. I'm more interested in the detail of what that relationship of intellectual assets driving revenues, because that's what pays my loans back. And I think I'll combine the answer also with the question earlier on about you banks. You're great at giving me an umbrella when the sun's shining, when I don't need it. If you've been sort of banking as long as I have in the UK, what you realise is there's pockets of debt need that aren't being fulfilled, mainly because of cost to serve and expertise. So the old adage, it's easier to borrow 100 million from me than it is to borrow 250,000. And it's sort of been made worse by kind of mobile banking and online banking, where you don't get to speak to a relationship manager, a bank manager. So there's a real need for sub 5 million EBITDA businesses in this country to try and borrow unsecured. It's really, really difficult. So high growth, 1 million EBITDA, 2 million EBITDA business, that's a pretty damn good business. But you try and borrow 2 or 3 million unsecured, it's really, really difficult. If you're a software IP rich business, we can now do that really comfortably now because we've got that secondary bit of security. Because in the past we would have said, "Oh, well, that's great, no problem. We'll take a charge over your factory building, or your other tangible assets." So they don't exist. So there's a real need above 5 million. You get into corporate finance, cash flow lending, very highly paid bankers they'll charge you 50 grand of accountancy advice and advisory for it. But there's that real need, I think, in the SME market. Dave.
When we talked about it before, when I was sort of asking you to come and talk here, I said, what are the primary benefits? And one of them is, do you get the money at a lower rate? And the other one is, do you get out of a personal guarantee? And you said yes, which you've just shown. In general, do you also get a reduction in the rate, or is it really just the free pass on the personal guarantee?
No, I think, as I say, you deserve to be rewarded with better terms. So as I say, you get the interest only at the start. We're not taking personal guarantees. Just to give you an idea, the kind of we'll price each individual case individually because that's only fair. Because if you're a higher risk, earlier stage, just turning break even, you should pay a higher interest cost than someone that's 2 or 3 million EBITDA already. But on average, we're lending, let's say 3 to 4% over base. So this is not, double figure digit lending. This is not venture debt that we're putting out here. This is just SME lending. What I'd really hope to, my next sort of evangelical play is with the banking regulators. I've got to be lending this. This is where Ben can help me. I've got to be doing this for a few years now. Unfortunately, I've probably got to lose some money as well to proof a loss rate, because what most people don't realise is when I'm lending like this, I have to set aside 100%, in fact more than 100%, I have to set aside in the bank's balance sheet to lend unsecured to these businesses, because there's no benefit given to UK banks for intangible assets. If I was lending on a property, I'd only have to set aside 30% of that loan, whereas I'm having to set aside 110% if I'm lending to an IP-rich business. So I need to lend on this for a few years, take some losses, go back to the banking regulators and say, look, it's not 100% relief you give me, but could you give me like 20% relief on this? And then I can pass those savings on to the customer, to come back to your...
Just that you were at the event at the House of Parliament, there was the guy from Aon, and you didn't mention insurance, but are you insuring each one of these deals? No, you're not. They're uninsured.
No, we're working with the insurance market on perhaps a bigger ticket version, so 10 million plus, where we'll use credit risk insurance to do perhaps deep tech stuff, where there's a real, 100 million quid's worth of IP. We want to lend 30 million. Bit too big a ticket for that. So we're working with insurance market and Aon in particular on that. But no, these are on our balance sheet. Yeah. If we lose money, we lose money. Touch wood.
There are lots of different parts of IP.
Yeah.
Do you find some areas of that easier to evaluate or de-risk or sell internally compared to others, i.e. patent over trademark, as an example?
Yeah, I'm at the moment we're talking, I've been lending to software companies for 30 years, so that's kind of familiar for me. And the software model means you can scale up quite quickly with SaaS software, and the revenue can come through pretty quick, and profits as well, actually, if you're doing SaaS properly. So we're talking to a lot of software, and I think that would be a big chunk of it. But I'm really delighted that we are getting in front of deep tech and, as you see, more patent-based businesses, because I think they'll be the bigger tickets, and we're going to have to learn on those ones. They're probably higher value in the IP that we're going to get as well. The challenge with those ones is they're probably going to have to raise more equity to get to the kind of the break-even stage that I need them to be to put debt out. And so there's probably going to be more equity raised required to get these businesses to the stage where I can put debt out. But we are, Ingot and the rest of we are taking a holistic view on. It's not just registered IP rights; it's the whole basket, because they usually are all contributing to each other to drive those revenues rather than in isolation.
Related to that, could brand ever be considered IP in this?
Oh, absolutely, yeah. I think when the Ingot guys come and join me, if you think about some of the big retail brands that have disappeared off our high street, no one's wanted to pick up the property estate, have they? But what has been sold very quickly and quite nicely is the brand and the domain name. So absolutely, yeah. Hiya.
Hi, it's really interesting and exciting to hear what you're offering. I think my introduction to valuations was when Martin and my former employer were working on banking on IP, and it's excellent to see that has actually now come to fruition. In terms of the valuations, what basis of valuation is used? Because obviously you need to balance up caution with recognition of the real intrinsic value of those intellectual property or other IP that's being valued.
Now, this is a test, Martin. Have I been listening to your presentations over these few months? Yeah, here we go.
I'm not in cahoots with Martin on this question.
Yeah, so Ingot provide us with three main valuations, and again, and we get to a bottom line one, which is orderly disposal value for us, an ODV. So you're right, it's got a conservative, and we spend a bit of time with our clients explaining this is not the market value, this is not what you're going to be offered by Microsoft or whatever. So bear that in mind. This is the collateral bank value, if you like. And so constituent parts of that, cost methodology, how much you've put in there in R&D, tax credits and things like that. We also, one I take a particular interest is the discounted cash flow methodology, and then we've got sort of a open market value basis. So for software companies, it could be a multiple of EBITDA. The guys at Ingot then triangulate that in terms of how far along the company are on their life cycle, if you like, the strength of that IP, and come up with a orderly disposal value. And it's really, if we catch this early at signs of distress, if we could then put it to the market, what kind of value we'll be thinking of at those stages. So yeah, it is more conservative than open market. It's not a gone liquidation value. It's somewhere in the middle. And yeah.
Okay.
Thank you. 7 out of 10 probably. I forgot some of it.
Thank you very much.
Thank you very much.
So I'm now going to hear from Marcus Studdart, who heads up the AIM and the UK primary markets here at LSEG.
Great, thank you, and good afternoon, everybody. I was just going to finish off with sort of some remarks about the broader financing ecosystem, and actually great to hear from both Ben and Neil about sort of some of the earlier stages. One of the things that we are sort of very committed to here at London Stock Exchange is actually joining up the various stages of the whole sort of financing continuum, and recognising that different investors and different providers of finance have a really important role to make sure that we have got a joined up sort of funding environment in the UK. Because as our sort of previous speakers have said, we're not lacking great businesses in this country, or actually finance. The problem is at some stages the finance and the capital just aren't coming together as easily as I think we would all like. And to that point, whilst London Stock Exchange is very well known for historically running public markets, so AIM that I'm responsible for in our main market, we have over recent years increasingly been focused on private markets as well. So at the very early sort of seed level stage, we've invested in a business called Flow, who are trying to make that whole seed stage of investing for VC and family offices easier. Some of you may have seen in the press that the government have talked quite a lot over the last 9 months or so about what has been referred to as PICES, or previously the intermittent trading venue, which is a whole sort of new regulatory framework that we're working with the FCA and the Treasury on, as are other market operators, to create genuinely the world's first proper regulated crossover market where the company is at the centre rather than sort of just investors trading bilaterally with each other, which will allow companies to stay private but have periodic access to liquidity. So to let early stage investors, founders, employees have some access to liquidity without having to become full public companies. So you'll be hearing a lot more about that from us over the coming months, with an intention of that sort of going live towards the end of this year. And then moving on to our public markets, we are actually quite unique as a market operator in that we don't just run a vibrant growth market or just a very well established main market. We operate both, and one of the reasons for that over the last 30 years is we want to be able to operate markets that are specifically tailored for companies at different stages of their development and for their investors, and we will remain sort of committed to that. So, I mean, first of all, from a public markets perspective, the question, often for high growth, and technology and IP-rich businesses is, well, why would I IPO? And if I was going to IPO, why in the UK? And I'm very conscious that there's been a lot of narrative in the press about certain high growth businesses, the likes of Arm, having chosen to list in the US rather than in the UK. And I'll come on just to try and dispel some of the myths around some of that commentary. But I mean, just to sort of summarise, first of all, companies IPO not only to access capital, but it is important to say that the public markets do provide access to the broadest set of investors and the deepest pools of capital, and that really came to the fore during the pandemic, for example, where £50 billion was raised across our markets in 2020, the same again in 2021. So £100 billion raised in 2 years, and a lot of that was by high growth technology companies. And that wasn't just at IPO. Most importantly, public companies tend to come back to the market regularly to do repeat rounds of further capital raising. So even on AIM, our growth market, over 80% of the money that's ever been raised has been by companies on the market coming back. So, the public markets and an IPO provide access to that long-term capital. We do actually have a very vibrant technology sector in this country on the public markets, with over £10 billion having been raised by over 50 companies just in the last sort of 3 years in that sector. But also, our markets provide access not just to UK domestic investors, but over 60% of investors in London listed shares are actually North American and global investors. So you can access the world's largest investors by listing in London. And also, actually, the performance of companies post-IPO, despite, again, some of the press commentary, has been very good. If you take individual companies one by one, their liquidity and their valuations actually are very comparable, if not, in some cases, higher in London than in other global markets. So that's the sort of the overview. But if we dig into it in a bit more detail, many of you will know that capital markets, not just public but private markets, have been challenging for the last couple of years because of a lot of the global headwinds that we all know about. Global instability, supply chain issues, higher interest rates, etc. But that said, the markets have very much remained open. We've raised nearly 400 billion over the last 10 years through our markets. London has consistently been the largest and most active European market by some margin for the many years, and remains so this year, almost twice as large in terms of volumes and capital raising than Stockholm, our next nearest competitor, and the most active market outside of the US and Greater China. And that's not just sort of dominated by the largest FTSE 100 companies. If you take all of the European growth markets last year and combine the capital that was raised, and there are over 25 European growth markets, 37% of all of the growth market capital was raised on AIM alone. And that has consistently been the case for many years. And one of the reasons for that, if you look at the bar chart along the bottom, is the light blue bit of the bar, which again is this further capital raising. So companies on market going back to institutions and raising follow-on capital. So last year alone, £1.6 billion was raised on AIM, which was quite significantly lower than in previous years. Nearly £9 billion was raised on AIM in 2021. So market conditions have been quieter, but we're starting to see that sort of pick up. We've had 4 IPOs onto AIM so far this year, and interestingly, 2 of those have been North American businesses that have come this way rather than the other way around. So just focusing on AIM a little bit more, we've got over 750 companies, It is very much a market for smaller growing businesses. So, the average market capitalisation or value of an owned company is about £100 million. And, we have over the years seen the sort of typical amount of money that AIM companies have raised continue to increase as the market has actually become more institutional and the institutions want to invest in larger sort of check sizes and know that there's going to be plenty of activity sort of post-IPO. AIM's also a very diverse market in terms of providing access to international companies, international investors, UK companies with very global and international sort of operations. And actually, nearly 100 of our AIM companies have US or North American sort of operations. Turning specifically to sort of technology, I know there's a lot going on this slide, but this is just some examples of tech and sort of consumer internet businesses that have IPO'd just in the last sort of 3 years, which I think surprises people actually, the volume that we've seen and the fact that they have been split across our market. So on the main market is sort of currently split into two main sort of sectors, standard and premium. And so 20 of those or 22 of those tech businesses have listed on the main market, 32 on AIM. And this reference to GEM at the bottom, we also have an accreditation for businesses where over 50% of their revenue comes from the green economy. So 3 of those businesses have been accredited that green economy mark. I think what's been interesting has been actually also the split and the spread of the size of those companies from low tens of millions up to multi-billion pound companies, raising again a very wide spread of investors. And if you look at the investors that have participated in these IPOs, again some well-known UK names, Schroders, Liontrust, etc., but also some of the world's largest tech investors, BlackRock, Fidelity, etc. So just to give you a kind of a feel for the vibrancy of the tech and IP heavy sectors in London. I think one of the things that anecdotally we hear back sometimes is a sort of feeling from founders and management teams that sometimes either the depth or the breadth of analyst coverage in Europe is not the same as in other markets. What you actually see, if you look at specific companies, is the largest tech businesses have got analyst coverage not just from UK banks, but from sort of global names, and actually have got a real spread of analysts. One of the things that we are working on, though, is we are very conscious that even where analyst coverage is being written, sometimes it's not being distributed as widely as it could be. And so a lot of companies, their message isn't getting out as broadly as it could be. And that's partly because of regulation and the way that analysts get paid for their work, and also it quite often doesn't go to high net worth and individuals. But there's a big regulatory reform piece going on to sort of address that. Without sort of sounding defensive, and I've mentioned the US a number of times, and it's sort of regrettable to almost have to do so, but during my career here there have been a number of sort of pivotal moments, either when we didn't join the Eurozone or when we left Europe, or currently, that there tends to be a sort of a narrative and a particular focus that we sometimes have to or feel like we need to address. And the current narrative in the media is very much that companies, as if by magic, and not just UK, but European businesses, will get a higher valuation, greater liquidity, greater analyst coverage by listing in the US compared to the UK. And I just wanted to have a go at putting that narrative to bed. If you actually look at the number of businesses that have listed in the US, UK businesses, and I'm sort of ignoring sort of very tiny cash shell SPACs, but companies that have raised over $100 million. So businesses with some heft to them. Over the last decade, there have only actually been 21 of those, which again I think is contrary to the public narrative. But of those 21, only 3, including ARM, are actually above their IPO price. 7 are delisted. The remaining 11 are trading on average down 72%. So just if any of you are leading high growth technology businesses and are thinking that the US might be the home for you, you might be absolutely right. It might be the biggest product market. There might be a trade buyer there. There might be a very specific reason. But if you just think that you're going to get a higher valuation, I might encourage you to question that. Similarly, we've seen a bit of narrative about sort of liquidity, and that's been based on some sort of very sort of superficial analysis where some commentators have sort of just taken the whole of the S&P 500, which clearly has got some very large companies and 500 companies, and compared that to the FTSE 100, and have said, there's more trading that takes place in the S&P 500. If you actually dig beneath the surface and look at the sort of the individual liquidity of companies, you find that it is broadly comparable and actually higher in the FTSE 100. So again, just to dispel a bit of narrative. And similarly on valuation, yes, some US businesses have very high valuations, but that's not a sort of a general trend. If you actually look at companies and you look at the quality of their revenue growth and the specific factors and try and kind of compare individual companies, you find that some companies in some high growth verticals and tech verticals are valued higher in the US, but plenty in the UK and Europe are also valued higher. So, it's a matter of really sort of digging down into individual peer groups and trying to pick stocks that are actually comparable rather than just saying, I'm a £10 million company that's just developed a new version of a phone, and I should be on the same multiple as Apple, which is something that we hear a little bit about. All of that said, so look, I'm trying to paint a picture actually of us having very strong foundations in the UK. And I've been in this business nearly 30 years, and one of the reasons I've enjoyed it so much is actually getting to talk to the businesses, private and public, and also seeing what companies do with the capital that they raise through our markets. And that fills me with a lot of optimism actually about the next crop of private businesses that are thinking about IPOing and those that are already on our markets. And I think we have a very strong market structure. That said, there is the biggest package of reform taking place at the moment that has happened in at least 3 or 4 decades. And I'm not going to go into all of it because I'm standing between you and lunch. But that covers everything from the listing rules and the disclosure that public companies need to make, the development of this new crossover market that I talked a little bit about, the provision of equity research, corporate governance rules, primarily around actually how much can UK executives and the C-suite of London-listed companies actually get paid, which clearly is important in a global market. And really importantly, we know that we have the world's second largest pension fund industry in the UK, and something in the order of magnitude of £60 billion of taxpayer money goes into tax relief for pension funds in the UK. But a lot of those pension funds are massively underinvested in the UK domestic market. And that's not just in the public markets, that's also the C, the D, the crossover rounds. And if we can start to change that, we've got a huge opportunity to divert a lot of capital into this economy. The government has started to make steps to change that with the consolidation of local authority pension funds, with in the spring budget the Chancellor announcing that he wants better disclosure on actually how much UK pension funds are allocating to UK equities, and also a regulatory mindset shift from the only focus being on cost to actually long-term value for money for pension holders. And all of those things, combined with potential some significant future change, I think we will start to see an increase in capital flowing back into UK equities. So there's a lot of reason to actually feel optimistic. I won't make you read the legal disclaimer. So that's touching upon quite a few themes, and I'm very happy for the next 5 or so minutes. If anyone's got any questions on any of that, very happy to take questions.
I've got a question. Under the accounting rules, which you went about the accounting rules, but under the accounting rules, you are allowed to put a homegrown intangible asset on your balance sheet if you can demonstrate that there is a liquid market for that particular kind of intangible. We've heard about the fact that banks are now prepared under certain circumstances to lend. One could imagine that there might end up being secondary markets for those loans, or possibly instruments created around the individual intangibles. You're obviously doing masses and masses of innovation. Can you see any opportunity for creating that kind of listed market for homegrown intangibles, or is that just impossible?
I actually can, and this, it's not. We don't have anything to announce at this point, but I think, if I think about two of the major innovations that we're very focused on at the moment, in the crossover market, it has forced all of us, us as a market operator, Treasury, FCA, Department of Business and Trade, Takeover Panel, all of the key regulators to think in a very different way. Historically, in markets globally, people have thought about private markets, illiquid, private, public markets, and there's been no merging of the two. And so with Pisces, actually, we've had to really open up the whole legislative sort of landscape, the Companies Act and various other bits, and see how to create sort of crossover legislation. So I think in the way that we've done that, there is the possibility of looking at things like intangible assets differently in the future. I think also with, we've got a big focus on digital market infrastructure and digital markets for completely new asset classes, not necessarily starting with equities. And this may well be a use case for digital markets in the future.
Any other
question in the middle?
Just when might we see the ICES crossover market?
So we are expecting all the legislation to be ready by the end of this year. And we're very much working in parallel with the Treasury and FCA to make sure that our market infrastructure is ready to go as soon as the legislation is ready. So relatively quickly. Question at the back.
Why do you think British pension funds won't invest in most British companies? Why the reluctance to do that?
It's been a number of factors. Some of it's tax, some of it's accounting. We've seen obviously the closure of defined benefit schemes, so they are now into sort of run-off mode and asset or liability matching. So they're focused very much on fixed income securities rather than equity to get capital growth. So I think it's been a combination of things. I think also to a certain extent, it's not been very visible. Because one of the benefits of the UK is because we are a very international and global marketplace. As we've started to see de-equitisation from UK institutions, that's been matched by flows from international investors. That hasn't happened to the same extent in other markets. So I just don't think it was as visible as it might have been. But to my mind, it's not because of the quality of the businesses. And you only need to look at the investment by US, Asian private equity into private companies, the percentage of listed shares, not just by the way in the FTSE 100, but all the way down to AIM, held by North American investors. International investors see the quality of our businesses. So I think the reasons have been multiple, and I think it will take a bit of moral suasion and probably a bit of regulation to change things. But we're starting to see that.
Okay, well, thank you very much. I think that's all.
Great.
Thank you very much. Thank you all for staying. The war stories and case studies earlier on are, in a sense, more inspirational to listen to, and brands and so on that you may have heard of. But personally, I found the second half incredibly interesting, and it seems to me that London is at a bit of a turning point in terms of innovation in the things that we've been moaning about ever since I set up Brand Finance nearly 30 years ago. We really are at a turning point in the stock market, in the debt market, and I certainly intend to have further meetings like this going forward, maybe once a year, where we can talk about what progress is being made. And I sincerely hope more brands and CMOs and people who are looking to finance their growth will start engaging with this. It's a little bit technical, but I think it's the sort of technicality that every sensible marketing person should understand more about. And it's interesting, Martin is one of those guys who started in marketing and is now a corporate leader. Let's hope it goes from strength to strength. In fact, one of the things I was going to ask is I wondered whether or not some of those instruments are of interest to you guys, like the lending instrument. But anyway, we can talk about that over lunch. So